All right. Hello, everybody. Welcome to the FOMC stream. In the next 15 minutes, we are going to find out if Mr. Jerome Powell is going to cut rates or not. Likely not going to be cutting rates, especially based on the PPI data we got this morning that we will talk about in just a little bit. And then around 2:30, so in about 45 minutes from now, we will get Jay Powell speaking. This is going to be his third, or he has 3 meetings left. This is going to be one of the last 3. And then he's officially done. He will not be the Fed chair anymore. And so we got a lot to talk about in terms of analyzing what Jay Powell is going to say. Thank you, everybody, for being here. I did not stream this morning. Honestly, guys, I knew I was going to stream a lot in the afternoon. I will be here for the next 3 hours. We are doing a full market close. I have nothing on my schedule for the rest of the day. Got through all the work stuff I needed to do over the past 2.5 days. So we're going to be here for Jay Powell. We're going to be here for market close. We're going to be here for Micron earnings. We will have a lot to talk about. So it just kind of didn't make sense to wake up that early, do the show, take 2-hour break, and then do this. So we're just going to stay here for the rest of the day. And we will be here to talk about too many mocktails last night. No, actually, I didn't drink. I did need to sleep, though. Like, that was part of the consideration because it's been a very exhausting 2 days. But I knew I was going to stream for so long in the afternoon that waking up at 5 a.m. just to stream, to take a couple-hour break to stream again for the next 3 hours didn't make a lot of sense. So regardless, we're here. We got a lot to talk about. I did forget that we had PPI today. Like, I don't know how many of you guys knew. Maybe you guys knew. Maybe you guys didn't. Maybe you guys didn't know because I didn't tell you guys yesterday, which is kind of my job. I should have told you guys. But I legit forgot we had PPI today. And we did. And I woke up for a little bit, saw it, and then I went right back to bed because this shit was ugly. 3.4? What are we doing? 3.4 versus 3%. It was not good. And then core was 3.9. Like, I saw it in the morning and I was like, first of all, I forgot we had PPI. Second of all, I'm like, this is just disgusting. I'm going back to bed. And then I wake up and I'm like, yeah, this is, I tweeted this at 9:24, and then I fell asleep right before the market opened. Yeah, this was not good. Having said that, the market's being a little weird because the S&P is down 0.5% right now, but a lot of stocks that you would think would be getting hit worse are not that much down, even though they've had a variety of different headlines over the past couple of days that have been weird. I'm not saying we're super green across the board. In fact, we're quite frankly more red than not. Also, oil spiking again because you have more of these headlines about the war not ending. A field in Iraq got struck. I can't believe I said Iraq got struck today. And that also created a lot of pressure on oil. WTI is back at 97. Brent crude is at 108 right now. So you've got Brent that's up. You have WTI that's up. The space names took a dip after they rallied yesterday. Rocket Lab announced $1 billion of dilution. A lot of companies announcing dilution. Shout out to Nebius, though. Even with the dilution, that stock is up 4% on the day. They upsized the dilution from 3.75 to 4 billion, and the stock is decently recovering. So I think, some of the dilution, same thing with Rocket Lab, even after, well, it's down 8% today. I know that's ugly, but I mean, it's still holding 70, which is nice even after the $1 billion dilution. So these companies are taking advantage of the increase in their stock prices and diluting, which makes sense, but their stock prices are not necessarily reflecting that badly to it. But you would think when you have a PPI print that's that bad, a Rocket Lab, a Nebius, an ASTS, a Palantir, they would all be down 4 or 5%, and they're not. A lot of them are actually holding up. Reddit barely down on the day. So I think it's a very interesting market, especially because Nvidia, again, 182.50. This thing's been oscillating between 181 and 184. Hasn't been making much noise either. And based on what Jay Powell says, we're going to see if any of this is priced in or if this stuff is still going to, take some more pain after Jay Powell ultimately announces what he does. Micron went to 475 last night. It's back at 465. We will cover Micron earnings today. I think that's going to be one of the biggest earnings outside of Nvidia that we've had all of Q4 to see if they can put up the growth and if that growth is perceived as cyclical or not. But yeah, very weird market. Like AMD at 200. CoreWeave is up 2.5% of the day. Tesla goes red. You would think Tesla and CoreWeave would move together given they're both in sort of that high beta growth sector, but that's not necessarily happening. You would think PPI would take down Iren a lot more than 1%, but Iren's barely moving. Duolingo's down 2.84%. The space names pumped like crazy yesterday. I don't know why. Then they went down. Bitcoin was at 76. Now it's at 71 because of PPI. So some things you would think are moving according to plan. Other things are not. SanDisk's at freaking $750. I don't know what exactly created the momentum in memory outside of the fact that Vera Rubin specs were dropped at GTC and it showed that there was going to be more HBM capacity, which is fair. So that's probably creating more excitement in memory. Circle's up another 1%. You've just got a lot of conflicting narratives going back and forth in terms of how the market's interpreting PPI and FOMC. The S&P 500 not able to recover above that 670 level either. So we're going to see. Space names up because Nvidia said space data center. Yeah, I mean, maybe that was the reason for it yesterday. We talked about that a little bit on yesterday's market open, but it didn't really see how that ultimately got the pump just based on saying space data centers, given I don't even know if some of these companies are actually like, is Redwire really going to play that much? Maybe they are. And that's why that stock is green. But we do have FOMC in 9 minutes. Well, we do have the decision in 9 minutes. And then in 30 minutes, we're going to get the actual meeting. So let's pull up the dot plot. The other thing that's really important today is we're going to get a new dot plot, a summary of economic projections. There is a 98.9% chance that we are not going to cut. There's actually, wow, this is funny. There's a 1% chance we hike today. It used to be 1% we would stay the same, and then or it would be like 1% we'd cut, 0% stay the same, and then the rest would get put out until like April, May, and June. Now it's actually 1.1% we hike today, which is not going to happen, but the fact that hikes are even back on the table is quite interesting. The European Central Bank, I believe, was quoted today as now being projected to hike 2 times in 2026, which would also not be the best. But 98.9% chance we're going to stay flat, and hopefully we continue to stay flat. Yeah, SpaceX did have a launch yesterday in California. Maybe that also inspired the space names. It was really weird for Rocket Lab, though, because it pumped heavy yesterday, and then they did the $1 billion offering, and now it's down 8% on the day. But the fact that they had that offering, it's almost like someone knew something was going to happen. And so whether it's Nebius, Rocket Lab, you got a lot of these different names that are taking advantage of the equity markets, which they should, as these stocks start to get more momentum. I mean, even SanDisk, people forget SanDisk diluted at 530 3 weeks ago. Now it's at 748. So, even they took advantage of the equity that they were able to raise. I mean, Amcor, they didn't really dilute, but they did like a secondary share. Amcor's up 3% of the day. They also took advantage of the equity markets a couple of weeks ago. So I think these companies are recognizing that maybe there's some more excitement in the air, and they should probably take advantage of it. And, if things turn around, then they're going to be in a better position because they're just going to have a lot more capital to see what we've got going on. Yes, Robinhood Social is also now live in beta. I did not get it, actually, which I don't know. It's weird. I haven't got the invite to it. I actually had a meeting with them a while ago about the Robinhood Social thing, but I didn't get access to beta yet. So I think they're probably rolling it out in a bunch of different, what do you call it, subsections of demographics. But I have a couple people that got access to it. They sent me some screenshots, and it's looking pretty cool. I don't really think it's going to give Twitter a run for its money in terms of being the place where people get financial news, but if you want to follow certain trades, that's where everything's verified, and that will be on the platform. Whereas on X, people can just post screenshots. So I do think that will be good for them. Hoodie, unfortunately, they had some bad February metrics. That stock staying around 76. Robinhood, Nvidia, and Rocket Lab have been 3 of the best names for covered calls. They've just stayed in a range. They are not breaking out to the upside, and they're not really breaking down to the downside. So, those covered calls have still been a decent strategy as that has continued to play out. Let me know what people have done over the past couple of days. We got 5 minutes until we get the decision from the Fed. Put in the chat if you bought anything, sold anything. What did you do differently over the past couple of days? I mean, realistically, we've had some big moves in certain names like a Nebius, like a Micron, like an Nvidia for 5 seconds, and then it faded. But the market's been relatively flat this week, flat to red, and we knew it was going to be red based on the futures that we had on Sunday. The S&P recovered. It was at 675 yesterday. We tried to go for 2 green days in a row, which we did get. I don't know if we're going to get 3 green days in a row. That would be contingent on today going green. And obviously, we kind of eliminated all the gains that we had over the past 2 days as we are down 0.5% right here. But, maybe things change with JPOW. Yep, VG. I mean, VG has got to be one of the funniest stocks to trade. This thing is back to 1376. It was at almost $10 2 days ago. But a bunch of headlines came out this morning about natural gas spiking based on all the different oil field attacks and refineries that are now shutting down or at least closing their production for a little bit. By the way, from everything I've been reading, the Strait of Hormuz is not open. There's like 20 ships that passed in the past couple of days, which is not enough to actually have the flow of oil be as strong as it needs to be. So regardless on what the administration is saying, you're not really seeing the Strait of Hormuz actually allow oil to come through. And I think that's also been causing some pain. And, as a result, it's hard to see the markets go higher. I was having a conversation with a couple people yesterday as the markets were kind of ending green on the day. And, there were some bottom signal, some real bottom signals that were starting to stand out. And we'll talk more about them after the FOMC. But the number one thing we all agreed on, and this is just the group of the people I was with as we were kind of discussing what would happen with the markets, if Trump were to say, we're done and we're leaving and the war is over, we've won, this market's going up. Because it feels like the only thing holding it back realistically, and maybe it's a little hard to say this now given the PPI data was that bad and more inflation can be horrible. But if we kind of leave Iran and the oil prices come down, maybe PPI relaxes. But it feels like the only thing holding this market back is this war. Like, it feels like we want to go up, right? Like, does anyone get that feeling like the market wants to break out? And every time it's tried to break out, it gets hit with some macro headline that makes it hard to break out. And I know the Nvidia 1 trillion thing wasn't that impressive, although Jensen did clarify his statements about what he meant. It's going to be a lot more than $1 trillion. He was only talking about Blackwell and Rubin. But it's like, if that wasn't enough to pump the markets because of this overhang of the war, if Trump says we are leaving tomorrow, the war is done, I think everything moves higher, like a lot higher. And maybe it will be like a 1 to 2 month move that eventually sell and may go away type of situation. But it does feel like a Rocket Lab wants to break out to 80, a Nebius wants to break out to 135, and Nvidia wants to get to 195, a Micron wants to get to 500, and maybe the earnings are going to help it today. Palantir been toying around with 160, Tesla been toying around with 420, like IGV, these software names. If oil goes down, that's a big macro headline for everybody, even if we don't get the rate cut. And then if we remove the volatility of this constant back and forth of if the war is going to end or not, I think the market goes up. But, now with PPI and increased levels of inflation, that's also not going to be the best. There's a chance they raise rates today. Yeah, we saw it on the CME projection tool. It's kind of crazy. I hope they don't, but there is a 1.1% chance. If Powell comes out and says we are raising rates, which I don't think would happen, but I do kind of want it to happen because it would be really funny, like really funny to see how Trump reacts to that. Portfolios probably wouldn't like it, but yeah, I hope that doesn't happen. The bottom signal is you sitting in the middle row of economy. Okay. That definitely feels like a bottom signal because I probably shouldn't have cared to pay the extra $100 to just get a freaking window seat. But it was about the principle. It was about the freaking principle. I realized, guys, I don't have that much to do today and tomorrow. I should have left last night. Like, I was looking at my schedule, like really looking at it, like an adult actually looking at their schedule, not just like assuming that I would have stuff to do. And I was like, oh my goodness, everything I needed to do, all the interviews, everything is done. Like, I don't really have to be here anymore. And I tried to switch my flight last night. I was like, dude, maybe I can get to the studio by today. And it was like $800 to switch the flight. I was like, all right, I'm not doing that. So yeah, I probably should have done a better job at planning this and I would have been back home by now. But regardless, we are here. And we will be celebrating one of Powell's last FOMCs in this hotel room in San Jose. And hopefully we'll see if we can get a spike. Let's do a quick pump or dump poll in the chat. We got 1 minute until Powell speaks. Well, not Powell speaks, until also we're getting the summary of economic projections, which is also really important. Pump or dump on FOMC decision. What do we think? I'll do a flat as well, even though if you pick flat, you're basically looking for a cop-out. I don't know, dude. I want to say we dump, but I feel like everyone's assuming we dump, so maybe we go high. But I don't really see how what's the logic to pump? It's priced in. PPI was disgusting. This war is not ending, apparently, and we'll talk a lot more about the war headlines. By the way, we'll be live for Micron earnings, so we'll be live for the next 3 hours, so we will be here for a while going through all this stuff, going into market close. We know the summary of economic projections is probably going to say 1 cut. Now, if they say 2 cuts, maybe that's where we get the pump. But realistically, it will be a question of if we can get more than 2 cuts or more than at least 1 cut, which now it feels like will be priced in just for 1 for 2026. All right, here we go. Decision should be out in a second. Let's pull it up. We should be getting it right now. And let's see what they do. Let's see. Here we go.
In the next 5 seconds, Kalshi's odds for the next Fed hike, 60% before 2028, 37 before 27. Steve Leisman has the decision. Hi, Steve.
Unchanged. Federal Reserve leaving interest rates unchanged at a range of 3.5 to 375. It was an 11-1 vote with Fed Governor Steve Micron again dissenting.
Wow. 11-1 to leave rates unchanged. These guys are not ready to cut rates. Let's see what we can get from the dot plot, which we should get pretty soon.
preferring to cut rates by 1/4 point. The Fed's saying very up high in its statement today that the implications of developments in the Middle East for the U.S. economy are uncertain. But other than that, pretty robust or actually positive economic outlook. It continues to say, as it did last time, that the economy or the economic activity is moving at a solid pace. Say job gains have been low, but the unemployment rate is little changed. Now, as for the outlook, still one cut built in this year for the median Fed
One cut. They're projecting one cut for 26.
official, bringing the rates down to 3.4, and one cut for next year, another additional cut for next year at 3.1%. The long run, something that's been ticking up over time, the long run neutral rate is now see at 3.1. That is up 1/10. On inflation, the median Fed official now looking for 2.7 on headline inflation. That's from 2.4 in the December forecast. Going back down to 2.2% in 2027. On core, looking for 2.7, up from 2.5, so 0.2 added there. Interestingly, GDP actually taking a tick up to 2.4 from 2.3 and 2.3 from 2% in 2027. So not seeing much of a GDP hit from the higher inflation forecast that is now part of the outlook. As for the dots, 7 officials want to hold, 12 want to cut. At least one cut or more. 5 of those want 2 cuts or more. The old range, guys, was a funds rate from, if you take all 19, the bottom was 2.1, the top was 3.9. It's come in a little tighter. Now it's 2.6 to 3.6. So a little bit of give on the dovish side, a little bit of give on the hawkish side, and now you have a little bit more centered around this 2.6 to 3.6 area. But again, the Federal Reserve emphasizing uncertainty. Interestingly, I would point out the idea that they upped their inflation forecast, but also they upped their GDP forecast. So that's kind of telling you perhaps where the center of the board is on the ultimate impact of the oil price shock. Guys?
All right, Steve, stick around here, please, because we have markets that are.
Okay, so you got the dot plot signaling that around 5 out of the 12 are ready for another cut in 26, aka 2 cuts. The overall median projection is 1 cut in 26, 1 cut in 2027. S&P's flat, folks. S&P's flat. You're not getting anything here. Trump did tweet like 2 hours ago, when is J. Powell finally going to cut rates? It's not today, but it's not just J. Powell, dude. That's an 11 to 1. That means Moran was the only one who voted to cut. Waller and I think the other dove is Hammock. Both chose not to cut, which means, like, I mean, it's not just Powell or the Hawks at this point. It's other people that have been very vocal about the idea that they want to cut, or that they think we should be cutting. They voted that maybe the inflation data is just too much this time, and we'll get their logic later as we get these statements out for actually not doing the cut, which, again, given the PPI that we saw this morning, yeah, it makes sense. This is like, I could not believe what I saw. By the way, the worst thing about this PPI, again, S&P's flat. Gold also took an ugly dump this morning, along with silver. Gold, wow, 4,800, down 2.3. It was at 49 last time I checked it, and 3.5 on silver. Copper is also taking a hit. Capex, that mining ETF, kind of following silver and gold. The worst thing about this producer price index is that this was before the oil spike. This is not even factoring in the oil spike, which is the worst thing about this PPI, because obviously it's March 18th. Oil prices started going up. Let's get an exact date. Crude started spiking March 4th. March 4th, we went from 74 to 94. So, I mean, basically the past 2 weeks of March have been bad for oil. If that's not going to figure itself out by the end of March, then, yeah, we're going to have pretty bad energy prices in March for PPI. And, you know, the Fed's going to have to once again ask themselves, all right, if this war doesn't end soon and PPI continues to be bad and that affects CPI, PCE, which also weren't good last week, you know, can we still cut? Having said that, there might be some more market catalysts outside of just inflation in general that gets the market to pump. I mean, some of these stocks defying the report by the Fed. AMD, that's going higher, 3.2%. Nvidia is still kind of flat, but it's at least kind of green on the day. Micron took a nasty dump from 500 to 467, but that's still green. Microsoft's down 1.29%. Rivian's up 1%. DoorDash is up or down 1.5%. United Health is flat. VG up 6.7%. SanDisk at 750. That looks like close to an all-time high. Nebius again saying the dilution they do not care about. The street cared about it yesterday, and kind of moving on from those concerns today. Bitcoin as well, pushing a little bit. The SoFi short report was one of the worst short reports I've ever read. I didn't fully dissect it, probably like Tanner did. I'm sure he's done a video and like gone in depth on it. But they essentially accuse SoFi of cooking the books. I'm like, dude, give me a bear case for SoFi, but don't tell me Anthony Noto is lying to everybody. Like, and by the way, the stock completely recovered the downside move. It fell to 1670, now it's back at 1750. So I thought the short report was not, I mean, the fact that SoFi had to put out a press release to say we're going to be suing these guys for defamation, which they should be, because I don't know. That just went the wrong way with me. But yeah, I don't think that had a lot of merit. But obviously the private credit names, the banks have been struggling, which is why SoFi has also been taking a hit. Did Micron hit 500? No, but I had dinner yesterday with one of the biggest Micron bulls that I know, and he thinks it's going to 500 tonight. So we'll talk more about Micron as we get into the market close. I have no position in it. I kind of agree. I think it's going up. I think they're gonna probably beat earnings by a couple billion and then beat EPS by a couple bucks. So it's probably going higher, dude. It's probably going higher. But then again, you know, maybe it's priced to perfection. This is the stuff about earnings that it's so hard to gamble on. You really just have to trust your gut, and sometimes you could be wrong on this stuff. United Health, that's down 0.5%. Verizon, that's down 2%. Coca-Cola, that's down. Your value stocks are going red. Your private credit stocks getting a little bit of love. Blue Owl. You know what the funniest thing I thought of yesterday? You know how Nvidia is investing in all these different companies like Nebius and CoreWeave and Lumentum and Coherent. Visa, by the way, that's also down 2.7%. Could you imagine if the private credit situation got so bad because all these data centers are being financed through private credit? Imagine the private credit got so bad in this country and like people were really thinking that the data center Capex build is over because of how much pain there is in private equity and private credit. That Nvidia came out and they're like, yeah, we're going to buy 10% of Blue Owl and KKR and Apollo. Like that would be the funniest thing ever if it got so bad that Nvidia was like, yeah, to save this data center Capex build out, we are just going to pump money and bail out the private credit names. I hope that doesn't happen, obviously. But it was a funny thought experiment because they're basically doing that with Nebius and CoreWeave. You know, like, I mean, they're not bailing them out, but they're continuing to support them to make sure they have the capital needed to be able to invest in this ecosystem because it all benefits Nvidia at the end of the day. It would be kind of crazy if they had to do that with like Blue Owl. But those names have been struggling, and obviously that's been creating some concern around the SoFis of the world and all of the small banks. Are we going to twice-a-year reporting? That has not been confirmed yet. Hopefully that doesn't happen. The proposal is going live by the SEC in a little bit. And I would imagine most companies hopefully opt out of it and continue to be quarterly. But in this game of retail investing, where all of us care so deeply, for us to not have information for 180 days on our companies that we cover, you know, it's not. First of all, the institutions will get the information. That's the other thing. I think retail investors that are championing for 2 times versus 4 times, to me, I don't know how they're thinking about it. They're like, oh, they're going to be more long-term. It's like, they're not going to be more long-term. They're going to have 3 months to optimize for results instead of 6 months. It's like, okay, like big deal. Second of all, the institutions will find out. They will get the numbers before retail, no matter what happens. If anything, the quarterly cycle makes it a little bit more of a level playing field. So, I mean, I hope a company like Nvidia wouldn't switch to that, but obviously time will tell, and we'll see how that plays out. Corey right there, that's up 3.3%. Pound here, flat on the day at 154.37. What did you think of OSS earnings? I have not gone through them in its entirety. I did think the revenue guide was decent. I know they missed on revenue very slightly, but they grew it at 70% year over year, 3.97% up. I mean, it was up 10% at one point, right? It hit $12. So they're executing. They continue to execute. This is a small cap. So this is one of those things where you have to be ready for the volatility. But I was prepared for this thing to go down 15, 20% today, just based off the idea that if there is a miss, the algos will get mad. It's a small cap, so it's easy for, you know, the stock price to go down. They missed. The guide was decent. It's not like it was a blowout quarter, and the stock's up 4%. And it really hasn't given you a chance to get in below $8. So I think OSS, when it comes to edge compute, is one of the most exciting names that's out there. I know it's small, but I also think it's one of the names that, just based on price action alone, has been able to develop an investor base that wants to buy it within that 8 to 11 range. And, you know, they get one contract worth $200-300 million. That's the entire market cap of the company. That's when this company probably gets re-rated to be $1 billion market cap. But, you know, it might take another year or so to get there. But I did think the earnings were relatively decent. Nebius right there, that's up 5% on the day. Nvidia, 182.78. Palantir, 154.33. Rocket Lab down about 7.6% again after that dilution, which to only be down $6 after $1 billion ATM, I think is not that bad, to be honest. So if you're in Rocket Lab, you shouldn't feel too upset about it. ASTS as well, basically flat right here on the day. Yes, that's also fair. That's a great point by Tony. So OSS sold one of the businesses that contributed the majority of their revenue, which was Bressner, after they acquired them. So yes, part of the reason they missed is due to that sale, which is also probably why the market didn't think it was, that big of a deal. Okay, so we have about 20 minutes until Jay Powell speaks. This will be one of his last 3 meetings, so I am going to miss Jay Powell. It's been a fun 3.5 years covering him. I do think he's done a decent job, contrary to what everyone thinks, navigating trillions of dollars of stimulus printed during COVID. He was definitely late in 2021, and he definitely got a hell of a little super boost with ChatGPT, kind of revitalizing the entire nature of technology. But outside of that, I think he's done an okay job. I do think we should be cutting rates right now. It's just hard when you look at the PPI data like we got this morning to make the case that Jay Powell can easily get the troops together to be able to cut. Again, PPI right here at 3.9 versus 3.7. So we have FOMC today. We'll have Micron earnings after the bell. We'll talk about that. What else happened in the morning? Let me see. Let me go through some of these feeds and see if we had anything happen in the morning. I don't think there were any major headlines outside of PPI. I'm sure Trump probably said some things that pissed off the markets to an extent. Oh, Trump did waive the Jones Act to get more production of oil. So you had that headline this morning. That's not really helping the way that oil is working, or the way that oil is being priced right now. You had the representatives go on the morning shows and try to get the market to be a little bit more okay about what's going on. Don't know if it's making that much of a difference. We got some Trump tweets right here. This was earlier in the morning. The Democrats' purposeful DHS shutdown is causing chaos at the airports. These lunatics are being totally unreasonable. They are fully to blame. I wonder what would happen if we finished off what's left of the Iranian terror state and let the countries that use it, we don't be responsible for so-called straight. That would get some of our non-responsive allies in gear. Remember, for all of those absolute fools out there, Iran is considered by everyone to be the #1 state sponsor of terror. We are rapidly putting them out of business. Okay, so just a lot of tweets this morning about Iran and being upset about them. Here's some clips from the trade representatives this morning as well.
So obviously we urge the Democrats to stop doing their shutdown brinksmanship. If you look at our last quarter, our GDP ended up being lower because of the government shutdown. Absent the shutdown, we would have been at over 3%. So anytime the Democrats, who profess to love government and think that government's the solution to everything, and then they shut down the government, it makes it incoherent, but it can have economic fallout too.
Well, you also have
here's another clip by Greer.
Confirmation hearing for Kevin Warsh.
Well, I hope we see it really soon. I mean, this idea that Washington keeps getting in the way of prosperity is incredibly frustrating. This is not what the American people want. We need to have a Fed that's functioning. We need to have a Fed that's responding to actual economic data and developments, not a Fed that has an axe to grind against the president. We're in the middle of huge geoeconomic and geopolitical changes. We're changing the trading system. President Trump is going around cleaning up all these hot spots of conflict. He's clearing out authoritarians who are not acting in the favor of the United States. We're trying to fix all these things. And you have all this, frankly, petty decision-making going on in Washington. And it's not what the people voted for. It's not what the people want. And they need to move it along.
See, the funny thing about this is he's saying that, Jay Powell's being political. If Kevin Warsh gets into office, which he will in the next 3 months, and he doesn't cut rates, even if he wants to, because this is still a democracy, you need a majority opinion to be able to get those rates cut. What is the administration going to say? Like, they can't publicly blame the guy they just put into office. I don't doubt they will try to do that, but that would be insane if they did. If Kevin Warsh can't get people to rally around him, that's part of the thing I was talking about last night with a lot of people. There has to be a Trump put based in to the war ending, because if the war doesn't end, oil will keep going up or it will stay elevated. We need oil to go down for at least 2 months minimum to get PPI to go down, to get CPI to go down, to get PCE to get down, to get all the metrics the Fed looks at from the BLS to actually be reasonable enough for them to say they want to cut, in order for Kevin Warsh, once he gets into office, to actually cut. Like, Kevin Warsh will be in office by May. The first meeting is June 17th. So if we don't end the war at least by the end of March, we're not going to have any significant amount of data that's going to be factored into the economy in order to get oil to come down, which is like, one of the biggest elements of how inflation would spike, at least from a energy perspective. In order for Kevin Warsh to even have the ability to coalesce all of the Fed members and say it's time to cut, even if his direction is that he's leaning towards a cut. Like if we end the war in April, at the end of April, or at the beginning of June, and the first FOMC is June 17th, how is he going to be able to justify a cut? The first cut, by the way, is now scheduled for December. That is what we're looking at on the summary of economic projections. And, that means we have a lot of time for liquidity to enter the system from those rate cuts. And now you have a lot of people thinking potentially rate hikes would be a different situation. Bitcoin right there, 71,744. As the market's taken a little bit more of a haircut, S&P, it is, there you go. There's your red candle, 666. We lost it. We were there for a little bit. We bumped up to 667 for a second. And now we're right back down to 665.39. Let's see if we go below that before Jay Powell speaks. And we'll see when he goes live in about 15 minutes. What will happen to Nvidia stock if Jensen says we hate our investors and double misses by 1,000% on EPS and revenue during an earnings report? That would probably not be the best thing for Nvidia. But based on how Jensen has been speaking about the earnings trajectory, it looks like they're going to grow pretty well. And again, the reason we're spending time focusing on Nvidia is it's not about Nvidia stock in and of itself, whether you own it or not. That's quite kind of irrelevant. To me, Nvidia is a proxy for the broader market. And it's really tough for the broader market to break out unless this one company has the ability to also break out. And unfortunately, nothing they said at this event, absolutely nothing, was enough to get the street excited, which to me is kind of bearish. Like if they can't say anything to get people to be excited, it's weird, but it also shows you where we are at the state of the AI trade. And maybe it's this Iran war that's the overhang that's not letting, do we really let Nvidia go to a $5 trillion market cap if oil is pushing 100? Like, probably not. This is why I disagree with, when Peter Lynch says, oh, if you worry about macro, then it's like, I get it. I get what he's trying to say, but I don't think it's wasting your time if you try to analyze the macro. And realistically, I think part of your, strategy around options, derivatives, hedging, et cetera, does have to take a look into the macro. And the macro right now is not conducive to Nvidia, no matter how much they put up results or how cheap they look. And same for a lot of other growth stocks that are out there. So I think this war really does need to end for things to play out to the upside. Do we have any other oil headlines from this morning? Again, that Defense Production Act, or not the Defense Production Act, the Jones Act. There is an update on that right here. Let me pull that up with some analysis. The 60-day waiver of the Jones Act, which should, at least to an extent, ease some of the fuel prices that we have right now as well.
Your initial thought on whether this will loosen things up at all, whether in the product markets or for crude itself?
By relaxing the requirement that ships transporting oil and gas have to be U.S. ships, you could expect some modest relief for fuel prices, especially on the U.S. East Coast. Based on academic studies, you could see some relief in the tune of roughly 10 cents a gallon, with the biggest effects in places like the East Coast that are net importers.
And I guess, Don, if you could kind of do the hierarchy of concerns here as we look at these markets. So, we look at WTI and Brent in terms of spot.
Again, the Jones Act should be good, but it is going to give it a little bit of time to ease up. It's not going to be a one-all solution. I was walking around San Jose yesterday. These were the gas prices. And by the way, this is just cash at $6.19 for regular. If you do credit, it's actually $6.39, which is crazy, bro. Like, absolutely free. That's just not sustainable. Like, especially if that continues to spike, it's just not going to be sustainable. Nvidia already fading, S&P continuing to fade, SoFi fading, Robinhood just went red, Rocket Lab going down even more. You're seeing some of these names, the little bump they had right after the decision, they are starting to come back down 665.85 on the S&P. This is not sustainable. And, if these oil prices continue, obviously, it's definitely not going to have a chance for things to not only recover, but have that breakout moment, even with good earnings, which right now, you're just not seeing that. In terms of updates on the war, so we did get an update from Bibi yesterday. A little bit of a weird video, to say the least, but a lot of people still are speculating that he is dead. Here's the video that he put out yesterday with Mike Huckabee, the ambassador to Israel, on how alive he is.
Mr. Prime Minister, I wanted you to know the president asked me to come and make sure you were okay.
Yes, Mike. Yes, I'm alive.
I checked that, and I'm happy to see that. But he wanted to make sure because, you guys get along too well.
I know, and we shake hands with 5 fingers in each hand. But I have to tell you, I'm alive, but I have this card.
Oh.
And don't read it. So it's a punch card.
Mm-hmm.
Today I erased 2 names on the punch cards, and you see how many more to go on this batch.
You know what the good news is? My name is not on the punch card.
Your name is on the list of the good guys.
Thank you.
And what the president, the U.S. forces are doing is incredible. We're very proud to stand shoulder to shoulder with them. And getting rid of these lunatics who would like to develop nuclear weapons and the means to deliver them to every American city after wiping out Israel. They ain't going to do that. We're wiping them out.
I love it. Thank you, Mr. Prime Minister. Good to see you.
Thank you, Mike.
Thanks. Take care.
Thank you.
The media around this war has been quite incredible to witness because this is the first war we have had in the age of AI. I mean, 2022, I don't think you could really say AI was as prevalent as it is in 2026. And so, it's a big deal if Netanyahu were to not be here because then the Iranians would claim victory that they were able to take him out. So that's why there's so much discussion. And I think to an extent, it obviously affects oil prices because, whoever's winning the war and the capacity for the war to continue or not continue is going to create the foundation for the market to think, at least perception-wise, if oil should be going up or down. So that's why he's making these videos and he's trying to prove to people, hey, no, I'm alive. It's just crazy because there is so much level of either disdain, discomfort, or skepticism around, if these videos are based on AI or not. And like the fact that presidents and prime ministers are having to prove they're alive to the general public and that it's not AI that's recreating them in some version of reality that's not real to show that they have strength in the war. It's quite incredible. And the future of warfare obviously is only going to continue to be mixed with a lot of these different signals that we're getting from AI. So, I mean, that was one of the videos we had out yesterday from Bibi. Trump again signing that Jones Act that's going to ease up oil prices a little bit, but it really hasn't helped today with oil spiking up to 90. Actually, we're at 94. We were at 97 in the morning. Now we're down to 94, so that's good. At least it's coming down a little bit right here. But still up above where we were a while ago. Meta is down 618. I thought Meta would get a bit more of a pump based on that Reuters headline of them firing 20% of their workforce. That hasn't been confirmed yet, but Street doesn't care. Street doesn't care. And my Twitter stopped working. Is my Twitter working? My Twitter, I know it was down in the morning today. Okay, now it's back. Yeah, it's been having a bunch of different issues. Meta did sign a 10-year lease for a new retail location in New York. This is where they're going to be selling a lot of their glasses. So I guess you had that headline this morning. But, market didn't care too much about that. Yeah, WTI crude right here at 95 just went red. Brent at 106. Natural gas is up about 0.03% on the day. What did you guys say on the poll about do you miss Powell or not? Let me pull that up right here. And then we'll take a look at what Jensen said yesterday. So they also had a financial analyst day. They also had a press Q&A. I did get a chance to ask Jensen a second question, which I posted on X. Some of you guys might have saw. I thought he had a good response to my question. 53% of you said you'll miss Powell. Okay. So will I. We'll see what happens with Kevin Warsh. I asked him about software, and I basically asked him. The audio on the video is not that great, so I don't want to play it because the audio is just not that. I'm gonna download it, edit it, and move up the dB on the audio, and then we'll watch it later. But I essentially said, hey, do you think software is going to be dead? And he was very adamant about the fact that AI is going to be helping software at its core, and he wanted people to understand that. By the way, I told you guys in the past, Jensen has zero issue with calling people out if they say something stupid. There were two things that happened when we were at the press Q&A. One, someone's phone went off. And Jensen literally stopped the entire room and he was like, whose phone is that? It was like a teacher in a classroom. And he like literally for 2 minutes, it was dead silent. And he was like, whose phone is that? And then he was like, my one pet peeve is that when I'm in a meeting, no one has their phone on. And I was like, oh shit, I made sure my phone, I was like, I know it's off right now. I know it's on Do Not Disturb, but let me make sure it's on Do Not Disturb. That was scary, bro. I genuinely was scared. The second thing is this lady from Taiwan asked Jensen a question. It was a really good question. And he started answering it. And within a minute into his answer, he stops and he looks at her because he looks at you every time he answers a question. And he's like, are you even paying attention to anything I'm saying? And this lady is talking to one of the people that has the mic. And she's trying to tell the person who gave her the mic, the person who was running around with the mic, to ask Jensen to say her name and the media publication she's with before he gives her an answer. And then Jensen is like, you want me to say your name? And she was like, yes, can you say my name first and then give me the answer? Because apparently she wanted like, I don't know, the credit of asking him a question or something. And so Jensen's like, all right, everyone, repeat after me. And then we all had to say her name. It was crazy, bro. He does not care. He will embarrass you like there was no tomorrow because the guy's worth $120 billion and he's managing a almost $5 trillion company. So he doesn't have the time for any games. But that was crazy. Like I legit felt like I was in high school. By the way, I had a dream last night. And in this, and I've told you guys about this. I think I told you guys a year ago. So if you guys are new to the channel, you probably haven't heard of this dream. But I keep having this dream, and I don't know what it says about my life. I don't know what it says about who I am. But I'm tired of getting this dream. Shout out to Jose, by the way. He also got to ask his question, and that was really fun. He asked Jensen, "What product do you think you guys created now that in 10 years from now people will have undermined?" And Jensen had a great answer to that. So that was also fun with Jose. I had a dream that I failed senior year of high school. I swear on my life, I had this dream last night, and I woke up like thinking I have to go check my grades online. Like I literally woke up thinking, what extra credits do I have to take to pass senior year of high school? I don't know why I keep getting this dream that I failed multiple subjects. Math is the one that keeps coming up for some reason. I like failed math class and chemistry. And it's this repeating dream every other month. It's like I have to go back to high school. I was like talking to my teachers in the dream, trying to figure out what extra like homework assignments I could submit. And I'm like, dude, I had a 4.25 GPA. I was fourth in my class in high school. Like, why am I stressing about failing high school? I don't know what the subliminal message is in that dream. But every other month that dream pops up, and it's weird. It was a nightmare. No, actually, like it was a little like it was the dream happened after I woke up. I saw the market, saw PPI, went back to bed. I woke up an hour later. And I just woke up thinking, do I need to submit my homework? Like, what the hell's happening? So yeah, hopefully those dreams stop, but it was kind of weird. All right, let's see what we get from J Powell. We got 2 minutes until he talks. This is going to be the last of 3 times, so we all have to enjoy it because at the end of the day, we've been studying every single word and syllable he has said for the past 3 years. So I definitely think we should be cherishing these moments. Bro went to Rutgers dreaming about failing high school. It's a really weird dream. Like next time when we have more time, I'm going to lay out all the details of this dream because I'm telling you guys, it happens in the exact same way every single time. And I feel like it's trying to tell me something. All right, we got about a minute. We should be getting J Powell.
They can't cut rates because it's just going to push up home prices. But what if the economy's, what if we are losing 92,000 jobs a month like we are now?
We're losing 20,000 people out of the working age population every month just because of demographics. So that, you know, if we change the immigration policy, we suddenly have, you know, millions of more immigrants coming in, then yeah, I'd be really worried about that. But right now it's still a tight labor market. I don't think it's going to get any looser given the lack of labor supply.
All right, Tim, we got maybe just 30 seconds before we have to go, right? So your final thoughts here. What does the economy need to get for it to kick back up into real growth again?
Well, I think we want to start seeing those cuts priced back in. And I think it is going to be a hawkish pause today, but I think the market's going to look through that a little bit because they know we're getting Kevin Warsh here in July, and the tone's going to be much different.
All right, Mr. Jerome Powell, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
All right, Q&A time.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. But if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Jay Powell saying you're not getting a cut unless inflation comes down.
Thank you, Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy.
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And you also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Even JPow's confused here, folks.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick Timoros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level. And we do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can we're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that? And to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labor market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay? But I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it. And I mean, everybody understands the arithmetic, and that's, you can say the break even is zero, but nonetheless, it's something we're watching carefully. And so, and are concerned about, but ultimately though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration that's the biggest factor there. And but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks. And, you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing and a very much more difficult thing because it does immediately raise the question of tension between the two parts of our mandate. But, you know, it has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that I had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but you know, we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by 1/10, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just
if there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal. And we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s. And I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time. And of course, people will feel that, but I don't want to speculate about what that might mean, because honestly, that would sound like I have some idea of what's actually going to happen. And I don't think anybody really does. We're going to see how this works out. And I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, you know, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, you know, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, you know, we always say we're going to learn more by the next meeting, and usually we do. But in this case, we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and you know, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
We also had ChatGPT in 2023 that helped the economy. Forgot to mention that.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought, and so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value perhaps in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year.
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive. And that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing. And what it does for us is, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs. And, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, expect it to continue. And we haven't really started to see the effects of generative AI. And that should certainly contribute to that. So it's quite unusual. And it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story. And if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that. In particular, if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere. And that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right. That was one of the final couple of meetings that Jay Powell will be doing as the official Fed chair. I don't think we got too much from that meeting, guys. I will be here for the next couple hours, so we can lock in and get ready to discuss and analyze everything that's happening. We will be live from Micron earnings, which is the biggest earnings of the day. I think we also have FedEx. FedEx is tomorrow. Micron, Red Cat, D local. Micron, Red Cat, D local. I didn't even know Lulu had earnings yesterday. We'll look at Lulu's numbers. We'll go through some of the stuff we missed yesterday. I know Oklo kept up their trend of zero revenue because it's Oklo. But yeah, S&P down 1%. We are lower than where we were before Jay Powell started talking. When he started talking, we were at 665. We're now at 663. It's not as aggressive. Nvidia did lose about $1. Robinhood's down about $1. Micron's flat. SoFi's flat. AMD was at 203. Now it's at 199. Again, nothing that crazy. VG continues to pump. VG and Next Decade again. Both of these being very contingent on the price of LNG, but also the broader sentiment around where natural gas is going. Next Decade, look at that, up 13% up on the day. VG up 14%. I would be, again, just a little hesitant of buying into this stuff because if you look at the chart of this thing, it's gone to 14 and it's come back down, gone to 12, come back down, gone to 13, come back down, just based on any sentiment change that the market has about the war, which given Trump and his desire to end this soon, maybe that does happen. And then all the energy stocks, oil and gas futures, LNG stocks take a bit of a hit. So it's just one of those things you have to be a little cautious about, but those are the names that are going green on the day. Bitcoin going red, Meta going red again, 616 right there down. Visa for some reason is down 3%. I think we have some news about agentic infrastructure within stable coins. I think I saw some of those headlines that could be affecting Visa, even though Visa's working with stable coins, but that's at 299. And then you got the S&P 500, unfortunately, taking a hit, down 1.1. So let's talk about what he said in the actual call itself. Yes, the Qatar facility that produces LNG got hit today, and I think the front running of that based on LNG prices going higher is likely being expressed in the market through VG and next decade. And then obviously oil being up 5% on the day. I think the biggest thing Jay Powell talked about, well, there's two things. Number one, well, let's take them step by step. The first thing I think that he mentioned, which is actually kind of what a lot of people have been concerned about, is this idea of stagflation. He was asked a question specifically about, do you think that we are in somewhat of a stagflationary environment? And again, he kind of gave a non-answer answer of, hey, we'll look at what happens with the data. But he did mention that the expectations that the Fed had for inflation to come down have completely been violated. And they feel that their expectations they have to readjust their expectations based on oil going up. He spent a good amount of time in the first 5 minutes of his introductory statement talking about energy prices leading to more inflation, which means that if growth in GDP continues to stay flat to, mediocre, and the Fed is expecting about 2.4%. So they did increase the expectation from 2.3%. Again, we got a bad GDP read last time at 0.7 versus 1.4. Trump is talking about 5% GDP growth. If we stay at half of that with inflation staying elevated, again, PPI today was absolutely horrendous. If that gets anywhere near 4%, I don't know how anyone can argue that we're not in stagflation. If inflation continues to pile up, we had 2.4 on CPI. Let's say we even get to 3% and GDP is at 2.4. We have more inflation than GDP growth. And let's say GDP gets to 3. Okay, so now we have inflation at 3, GDP at 3. I mean, it's not necessarily an environment where one could argue that stagflationary forces aren't having any level of meaningful impact. Now, the way that doesn't happen is we either grow dramatically compared to our inflation expectations, or we lower inflation by ending the war, which, again, Jay Powell, that's the other thing he talked about, did mention the war, and he didn't really get political about it. He just said, hey, because this is happening, it's creating more demand for oil with a lot less supply for it. And as a result, that's also creating some pain in the energy markets. Circle right there, is that green on the day based on stablecoin news? Wow, 133. The stock was 50 a month ago. This has been the biggest. Again, this thing did get to 300, so you do have a lot of bag holders here. But if you entered in, any time before even 110, you're sitting pretty on this. 133 as more stablecoin news continues to pump this one up. The other big thing I think that Jay Powell said that was also very interesting is the idea of unemployment. Now, once again, remember why we cut in December. Do not forget, we cut in December as SPY hits the low of the day because of Jay Powell's fears around the labor market. Wow, 662.84. Look at that candle right there. Got hit pretty hard right at 663.50. His fears around the downside risk to the labor market. He did a 180 today and said the fears to the labor market are not as strong as we expected 4 months ago. Now, he's not wrong based on the data that we've seen, whether it's unemployment claims, ADP private payrolls, etc. But anecdotally, when you've got Amazon cutting 30,000 people, Intel cutting thousands of people, UPS cutting 60,000 people, you got Meta thinking of cutting 14,000 people. I mean, it really begs the question, all right, is that how we're going to get inflation to come down? By people just losing their jobs and having a natural sort of shift against inflation via demand, which is what I think Jay Powell actually is saying without saying. Like when he's saying we're not worried about the labor market, what I think he's implicitly trying to say is that inflation is too high and we need something to bring it down. And maybe the only way to bring it down is, guess what? People lose their jobs, so they stop spending. Well, that's a recession, right? Now, Jay Powell can't say the R word. He can't mention that. So he's kind of implying, yeah, the labor market's okay. We don't have to really worry about the labor market, aka cut rates to stimulate it. Because if we cut rates to stimulate it and inflation's already high, then the effect of people losing their jobs, which would be good for inflation to come down, because again, less natural demand, wouldn't happen if they cut rates. So I think, he's trying to imply that we can't really cut rates around the labor market by using the data from the BLS to say the labor market's not in a bad situation, while also understanding that even if it is in a bad situation, it might be one of the only things that can really bring inflation down. And it sounds weird because it feels like we're in this massive, massive fight with inflation like we were back in 2023, when that's not the case. Inflation's, at least CPI, under 3%, even if PPI is above 3% today. In June of 2022, it was at 10%. But it feels like we're in that fight because of oil prices. And the spike on oil is making everyone get those flashbacks of 2022 when we were at 120 a barrel, and we stayed there for a bit, and inflation went to the largest level that it had been in 40 years. And unfortunately, I think those fears are, what the Fed is also worried about. 662.93 right there on the S&P 500 as that one continues to take a little bit more of some downside momentum. SanDisk and Micron, we'll talk more about that as well. Obviously, we've got the memory names. Wow, they're not affected by Powell or inflation. SanDisk at 755. Micron was higher in the morning. It did dip from 476 to 460, but it was also at like 390 a week ago. And so you are seeing some more momentum for the memory names. Where are some of the value names? UPS, that's down 1% on the day. Verizon is down 2% on the day. Even memory is not catching a bid in the growth sell-off. Coca-Cola is down 2.9%. Nvidia just lost 181. Next decade and VG really are your hedges today. Those are getting some momentum. OSS, nice to see that one holding on to at least a 1% move. Visa, again, down 3%. SoFi goes red. AMD, not red, but it looks like it wants to go red. VG up 10%. Then Amcor as well. That was up 3%. Now that's back down to 46.70. The other thing Powell said is that if no Fed chair is confirmed by the end of my term, I would serve out the remaining term. Obviously, there will be someone who's formally nominated, which will be Kevin Warsh, and that'll happen probably in the next month. And will Powell stay as a governor? He said he'll make that decision at the time. My gut tells me he's going to leave because I don't think he wants to be under Kevin Warsh. But, maybe that's something that he chooses to do. And again, when you look at the summary of economic projections, which I thought was also really interesting, they're still estimating one cut this year, one cut next year. The question is going to be, do they seriously stick to that and actually get you one cut? Or, is there a chance that when Kevin Warsh comes in, we're going to have more than that? Gold continuing to feel the pain. I think when Powell started talking about the impact of energy inflation in particular, that's when commodities really started getting a hit, because obviously if energy inflation continues, we're going to have to keep raising rates. And you would think gold and silver are the hedge, and that should be where you go when that happens. But in reality, gold and silver to me are starting to feel like speculative plays. And I've been, pretty explicit about this for the past couple of weeks right now. It's a reason I got out of my copper calls, because I felt that copper was just following gold and silver. And if it's all being seen as speculation, which guess what speculation needs? It needs liquidity. And rate cuts is what happens for liquidity. Rate hikes, or staying at neutral, is how you don't get liquidity. Gold and silver don't end up, like, you should be buying gold if we think there's going to be massive energy inflation, right? Because that's your hedge. But if gold is now a speculative asset, it needs liquidity, which means it needs the same thing Bitcoin needs, which are rate cuts. And I know I'm oversimplifying a little bit, because gold has had an incredible run compared to Bitcoin over the past year. And, if you bought gold at 2,000, you're probably not that upset. It's down 700 points. But the point is, for those that are buying gold at these levels, or for those that are, bought gold at 52, 5,300, I think at this point, it's not about infinite money printing as the debasement trade creates gold as the winner. It's more about, hey, like, if more people are piling in, you need more liquidity. And right now, the Fed is being pretty explicit that they are not going to provide that liquidity. 663 on the S&P 500 right now. Everyone is piling into cash. That is something I agree with. If you take a look at the folks, we are hitting a high of the week, if I'm not wrong, 100.1. Everyone is absolutely piling into cash in some respects. Can you see this, guys, right here? Let's see if that shows up. And it looks like that's kind of also what's causing the pain. Why is that not showing? I don't know. Let me try sharing it again. But 100.1 right there. It's not showing. They got my screen, folks. They got my StreamYard. At least the Wi-Fi. There it is. There we go. At least the Wi-Fi is decent today. 100.1. So, I mean, yeah, I think people are saying screw gold, screw silver, screw Bitcoin. We are just going to get into cash until we find a little bit better of an understanding of how this entire market is playing out. And speaking of that, let's talk about some of this macro stuff. We got about 30 minutes until the market closes and we get into Micron earnings. We'll do a little bit of a preview of Micron. Very curious to see what people have to say. I jokingly asked in the chat, are we buying Micron before earnings? I'm probably not, but man, I feel like it's going to go up. Like, it just feels like it's going to go up. But those are the moments where it doesn't. And then it goes down. Like, they're going to beat earnings aggressively. But the problem is, I want to say it's priced in, but it's not priced in. Like, I think the level of beat they're going to have is actually not priced in. I just don't know if the market's going to give them the juice that they need. But let's look at some macro stuff, because some of this macro stuff I also think is really important. So a couple of different things. Let's pull this up right here. For those asking about Hood, again, there's not that much new news on Hood other than the fact that we talked about Robinhood Social this morning. That's a new initiative that they have, and I think that'll be good. I don't think that's going to re-rate the company anytime soon. 75.50. The fact that it's holding the 75 guys, to me is actually impressive. It's holding the $70 range in a world in which their February metrics weren't that good, and Bitcoin is also not doing the best. So, I don't think there are any updates that they can put out to change the narrative on the stock right now. Same thing with a lot of these growth names, especially given this one is tied to Bitcoin. But Robinhood Social stuff is good. It's not going to move the needle, not in this market, and very similar to the other names that are also not really getting some love. Any thoughts on TTD? So they had a bad headline yesterday with what was the company that said they're going to stop using TTD as one of their platform providers? I forgot the name of the company, but there was one of the ad providers or one of the ad tech companies that said they weren't going to be using them. And it's kind of crazy because the freaking thing got a $150 million purchase by their founder. And still one of these headlines took it down yesterday. Publicis, I don't know how to say this name, but they're reportedly telling their clients they will no longer recommend the trade desk for digital media buying after a recent audit. According to Ad Age, the report says that they found multiple violations of its master service agreement with the trade desk. Yeah. I mean, look, I wasn't interested in this name before the CEO bought. I thought about it after the CEO bought, but obviously the CEO bought a lot to probably hide some of the bad stuff that's going on under the hood. And unfortunately, this one is just hit with bad headlines. I feel like AppLovin, even though I want to say it's more expensive, but it's actually not more expensive. On some metrics, it's more expensive than TTD, like price to sales. But on other metrics, its earnings growth is phenomenal. AppLovin is a real ad buy here. Or even a Reddit, but Reddit also I think is a little bit too high beta compared to the growth. All right, so let's look at some of the macro stuff, because some of this macro stuff I think is really interesting. First of all, put premiums are the highest they've been since 2021. This is the steepest skew we've seen in 5 years on S&P 500 1-month put premiums. Why? Because people are scared. People are obviously scared. Now, to me, this is bullish, because if people are this scared, again, the crash usually happens when people are feeling everything's great. What's the example? October 9th. I think a lot of us here were at all-time highs in that portfolio. A lot of us felt invincible, including myself. And that is when things feel, that's when things are the most susceptible to getting hit. And we got hit. I don't think when everything's trading at depressed valuations in the past 7 months, Nvidia being one of the the biggest names, Meta obviously part of that, Microsoft below 20 times earnings, that the put premiums that are now trading at this high level deserve to sort of be manifested in a way that leads to another 10-15% crash. Like, I think this is more hedging versus people necessarily think it's going to happen in an aggressive way, but it does mean that people are scared, and that's something that we can't forget about. The other chart here that I thought was also very interesting, let's pull this up right here. Mr. Jason Papergains tweeted this today, and he even showed me this stat because I didn't used to track it, but now I do track it. The NAAIM Investor Exposure Index. This is basically an index of how much large institutions are exposed to the broader markets. Came in at 66.9 yesterday. It was at 92 on average in Q4. I think when Jason was on last Tuesday, we looked at it and it was around 72. So another metric to show that there are professional investors, hedge funds, institutions that are de-risking. And they're one of the reasons they're de-risking is probably because of the instability in oil and their inability to fully understand when this war is going to come to an end. Again, we had that massive run a week ago when Trump said the war will come to an end. Since then, he hasn't really proven that would happen. I mean, we looked at this chart last week, but financials are having their worst week of outflows since 2017. Like, financials are getting sold off. We looked at a chart 2 days ago of hedge funds selling the most they've sold since 2018. We just looked at the put skews chart being at the highest levels it's been in since 2021 in terms of people paying more for premiums. The XLK, which is the tech sector ETF, is shorted at the highest level since 2016 in over a decade. I mean, people are scared. People are obviously scared. S&P 500 right there down 1.15%. And then to top it all off, I mean, as I say, people are scared. I'm saying that based on the data that we're looking at, which the logical inclusion becomes that people are scared. But if you look at fear and greed, we're at extreme fear. And quite frankly, I don't necessarily know if we're at extreme fear, if it feels like extreme fear. Now, I know there are some metrics we've just gone through that are pointing to fear in the broader markets. But is this extreme fear Liberation Day level prices? No, probably not, right? I mean, when you have a Nebius that's pumping, when you have a Rocket Lab that's above 70, Palantir still at 150, like it's not, when we had real extreme fear, even in November, those prices were a lot worse. Like Rocket Lab was like $40, right? And so I don't know if we're necessarily getting the same types of deals we had last time we were in extreme fear, but if your favorite names are on discount and you think they don't deserve to be on discount, usually the sentiment when it comes to extreme fear is a buy on those names, which is, not the worst thing in the world. S&P is only down 3.2% year to date. Well, that's also my point as well, right? We're only down 3% year to date. Does that qualify as extreme fear? Probably not. But given we have been stuck in a range since literally end of October, and now you're starting to see the S&P lose 670, which again, we've talked about, that's the level we cannot lose. And we recovered on Monday and yesterday, Tuesday, and in the morning, and now it's just down. So unfortunately, losing those levels is not the best thing that we want to see. Didn't you say we were at the bottom? So there's two things that we talked about last night. I was talking with a bunch of other investors. By the way, Stock Talk will be on the show probably after Micron earnings, so in around an hour. And he was also, and I think this conversation will be good with him because he was one of the people making this argument that, there is a world where we could be bottoming. But two things have to happen. Number one, we have to reclaim some serious moving averages on the S&P. And yesterday we got pretty damn close, dude. We got pretty freaking close, pushing 675, which is when we started thinking, hey, maybe there's a world where Trump comes out, says the war is over, and then boom, S&P 690, and then we're back to business. Again, that has to happen for us to seriously bottom. And when you get an event like this today with PPI being way worse than expected, that kind of puts a wrench in that thesis. Unless Trump comes out and tries to save the day by toggling out of the war, I think it's become pretty obvious he can't easily do that right now. And until he does, we're stuck in this situation. But number two is, these indices reclaiming some of the major moving averages. Even the Qs were fighting yesterday. I know they only got up to 607, but 614 is the level that we were looking for. Last week, we got there, we got to 613, then we fell back down. Realistically, getting above 620 would be incredible. It made a go for it yesterday, which really made people feel there's a shot that maybe you get the right string of events coming in place and we move forward. Now we're right back to 596. Why? Because we get a bad PPI print. You get JPOW that's not going to cut. And then you get more headlines that don't signal the war is ending anytime soon, which once again continues to reaffirm, in my opinion, that it's a market for covered calls. And I think one of the literally my Nvidia calls, I thought they would be called away after GTC, right back down. The market's just not, even after Jensen's $1 trillion number, which we'll talk about in a second. And it's the same for Rocket Lab. Let's say you had Rocket Lab calls the day they pumped up 8%. Guess what they did? Raised $1 billion. Why? Because Peter Beck probably knows that it's going to be pretty expensive to do all the things that he wants to do over the coming years, along with Neutron, which is kind of the big catalyst for this thing, down 10% on the day. And he knows that his stock might be a little elevated in terms of its valuation, which is not a bad thing. But at that moment, you raise money. What did Nebius do once they got a pump, which, the market is kind of forgiving them for to an extent. But when this thing got to 130, Nebius said, hey, yeah, we got a $27 billion deal with Meta. But we are also, essentially these companies metaphorically are running a covered call on their own stocks, right? When they're raising money at these heavy levels, they're basically saying, I don't think, for example, in the words of Rocket Lab, if I'm Peter Beck, it's him saying with his financial team, we don't think this stock should probably be above XYZ level, whether it's 75, 80, whatever price they issue the $1 billion at. And they didn't literally issue it. They just put out the offering. So eventually they can do it whenever they want. And we are going to take advantage of that price, just like when you're selling a covered call when a stock is at a high level, because you don't think it is going to go above it. And then if it goes down, which you expect it to go down or at least stay flat, you're going to generate all the alpha from the upside in terms of the volatility. And I feel like a lot of these companies are doing that. And the reason they're doing that is because they know the macro is so unstable. They can't just, because why would Nebius issue $4 billion of convertible notes if they knew their stock was going to 150, 160 soon? They would wait until it gets up to they would wait until they get a really good premium, but they did. The stock went from 90 to 130. And that's when they decided, all right, now it's time. And so I think a lot of these companies are just trying to play the market as well, just like we are. And they are stuck in the chop, but they are trying to benefit from the chop as well. S&P 500 low of the day, 662.40. 662.40. VG is at 1492. My Nvidia calls were 185, which again, I thought would be in trouble on Monday, and they weren't. VG 1494. That's up 15% on the day as well. You got VG and Next Decade. That is also up 10%. Where is the VIX? The VIX should be above 24. It was at 24 when J-Powell was speaking. 24.21. 24.21 on the VIX. Okay, let's talk a little bit about, we have 20 minutes until earnings. I want to play what Jensen said yesterday because I think this is really important. It'll set up our conversation into Micron. And then we will also talk about Micron as well. Am I stupid for thinking Meta is an obvious buy at these levels? No, but unfortunately, and I think Jason talked about this as well, it really does feel like the street wants this to go under 600. I do not blame anyone buying this thing at 18 times forward earnings. I think it's even lower than 18 times now. But, you know, if the street's upset that Meta is not putting out an AI model, when that's not their business is advertising, the street once again is going back to the sentiment of, oh, like Meta should be doing more in AI than just ads, which is really stupid, but the street is the street. And I guess they're thinking the way they want to think about it. No, I wouldn't be afraid of buying at these levels, but you know, if S&P gets to 630, 640, if we actually have a real breakdown, Meta's going below 600. And so the question now becomes, do you DCA and are you okay with that? Or do you want to wait for a little bit better of a price if this war ends up intensifying and oil continues to stay elevated? Here's what Jensen had to say at the financial analyst Q&A yesterday. So I wasn't at this one. This was for all the financial analyst people. And here's what he tried to do to clarify his $1 trillion statement. You can tell he's a bit annoyed that people don't care enough about his $1 trillion remarks. And he's trying to get people to realize it's going to be a lot more than $1 trillion.
I wanted to answer the questions about what I said here a little bit more. First of all, a year ago, I said that we had strong visibility of our Blackwell and Rubin shipments of $500 billion through 2026. I was standing in 2025, right? And so GTC 2025 is around, what was it? Was it March, April? It was October?
October.
Okay, October. I was standing there. You sure? It was October?
I'm sure.
GTC DC or GTC? I said it twice though. The first time I said it was GTC here, right?
I think you've been saying it twice.
Yeah.
But I don't think all the way back.
I see, yeah. Okay, anyways. Anyhow, in 2025, one of those months, I said that we have strong visibility of Blackwell plus Rubin demand, purchase orders and demand, okay, very firm demand of $500 billion. And there were a lot of questions from many of you that you know, so where are we now? And so you wanted an update on where we are now. And so I thought I'd give you guys an update. Where we're standing right now, and what month are we? Just for the record, March. And so here we are in March. The end of 2027, as you know, is many more months away. I just want to first let you guys know that. However, because we're building infrastructure in factories and the lead times for everyone is long, they want to make sure they give us firm demand or give us purchase orders and firm demand as early as they can to secure their supply, okay? And so we have strong confidence and visibility, and strong confidence of $1 trillion plus. You know, it's not a floating point number, you guys, okay? It is also not 94 digits of accuracy, okay? And we're not counting cents. You can keep your cents. However, we have strong visibility of $1 trillion plus of Blackwell plus Rubin. And the reason why it's only Blackwell plus Rubin and not all of the other things that we sell is because I referenced it from the last year when I was only talking about Blackwell and Rubin. Does that make sense? So last year, we didn't have Grok. Last year, we weren't selling standalone CPUs. Last year, we didn't have many of the things that we have to sell now. And so it wouldn't have made sense for me to include those today and not because we didn't have those things yesterday. Does that make sense? Somebody nod, then I can continue, okay? And and so therefore, a couple of things. It's only Blackwell and Rubin. It's not Feynman. It's not Rubin, Rubin Ultra. It's not.
This is the thing Jensen's really trying to get the market to understand. So remember, that $1 trillion is through 2027, not explicitly only in 2027, which makes it over 2.5 years, not 1 year, which changes the earnings estimate. But and that's why the stock faded. But now Jensen's trying to say, guys, I'm giving you the visibility that we have, but there's a lot of stuff I didn't include into the guidance because I can't include that stuff yet. And he's trying to tell the finance people, look, realistically, he's talking to Wall Street. All the finance guys have a big price target on Nvidia. Like, there's no one on the sell side that's against the company. You know, there's not some troll out there that's saying Nvidia should be worth $50 and like spreading a lot of FUD outside of Michael Burry, who's just not that bullish on it. But like all the finance guys have $250 to $300 targets. So I think Jensen right here is trying to talk to the algorithms, analyzing every word he says to get them to realize it's going to be a lot more than $1 trillion. It's just not working. And so far, the street doesn't believe they're actually going to have that type of growth.
Any of those things. It's not Vera standalone. It's not Grok. So Blackwell plus Rubin, we have high confidence, strong visibility, demand, forecast, purchase orders of $1 trillion plus. We close businesses that we ship oftentimes, and we expect to close and ship more business between now and the end of 2027. We expect to close, book, and ship more business on top of this between now and 2027. And the reason for that is because we expect to be coming to work between now and the end of 2027. Now, unlike other businesses, because we build and complete systems of this quality, we can actually win, book, ship new business in the same quarter. Of course, you can't do that if you have to build an ASIC or, obviously, if you don't.
And then he goes into why Nvidia has the best chips and why, they are still the best deal in the market compared to all the other ASICs that are out there. So at its core, I'll leave the link in the chat. It's an hour, 30 minutes for those that want to listen to it. I was listening to a little bit of it last night. Jensen's frustrated. He's upset. He obviously feels the stock should be much higher than where it is right now. Meta right there, 614. And the street is not giving him the benefit of the doubt on these projections. People in the chat are mentioning, well, this is all based on Capex going down or Capex going up. And if Capex goes down, Jensen's going to be wrong. What Jensen's implying is that Capex is not going down. He's implying this $1 trillion of visibility that he's seeing for only Blackwell and Rubin, not even Rubin Ultra, just the basic Rubin, going into 2027, is implying Capex will be very strong. You can either believe him or not believe him, but the market obviously doesn't believe him, and as a result, it's now a question of he said, she said. There was another question inside of that video where someone said, they basically asked the question someone asked in the chat, which is, hey, what about your hyperscaler customers? Like, they need to show that they're increasing their revenues based on all this Capex. The average spend on Capex is about 20% above the free cash flow from the Amazons, Metas, Googles, Microsofts of the world. And so the question to Jensen was like, hey, until they start seeing a significant level of ROI, which they are to an extent, Google Cloud and all those other elements of different parts of the business, cloud going at 48%, but it's not like massive ROI yet, right? It's not like life-changing yet. Definitely investors are not feeling that. Otherwise, those stocks will be priced differently. If they don't see those ROIs, how can they keep justifying the spend on Nvidia? And what Jensen said is that if you look at Anthropic and OpenAI, they are growing at levels that are unprecedented to the point where they will be doing hundreds of billions of dollars of revenue in the next couple of years, which means they will need massive amounts of compute. By the way, if OpenAI and Anthropic are doing that much revenue, that means the hyperscalers are facilitating that. Oracle, Microsoft, Amazon, Google, Microsoft actually potentially suing OpenAI today based on OpenAI and AWS working together, which is a whole different story that we'll talk about. Kind of crazy, but I don't think Sam Altman was happy when he saw that headline today. But basically, Jensen's saying, no, the Capex is going to continue because those hyperscalers will absolutely see the ROI. And for them to get even more ROI, which goes into the whole question about inference and then inference leading to tokens leading to revenue, that will have to come back to NVIDIA, which is the thesis right here. And that thesis is not just important for NVIDIA. It is important for AMD. It's important for Broadcom. It's important for Amkor. It's important for all the other smaller companies. It's definitely important for Micron. So let's get into the Micron conversation. We have 11 minutes. Put in the chat if you own Micron. I'll do the Micron pump or dump poll in the chat. The biggest thing for Micron, and the reason I think it pumped, is because at GTC, their Rubin specs were shown. And those specs that were shown include a lot more focus on HBM. Now, there are some levels of the Grok LPU that are going to have a 0 HBM and more SRAM, but Micron, which sells a ton of HBM based on the other 75% of Vera Rubin chips that are planned to be in these AI factories that Jensen is mentioning, Micron right there, 467, they're going to need a lot more HBM. And as a result of needing a lot more HBM, I think that's why Micron has been getting the pump. The question is going to be, will that show up in the guidance that Micron gives today? And is that going to be enough to get them to really get some momentum? So let's talk about what has happened over the last 90 days with Micron. Number one, they fully sold out of their entire 2026 HBM AI memory supply. Remember, a memory fab takes a couple of years to bring online. That's another reason these Micron types of stocks, SanDisk, Western Digital, Seagate, etc., Samsung, SK Hynix, the reason they've been catching the bid is because it is not easy to bring up a fab online when it comes to memory supply. But memory supply is one of the most important things for these context windows when it comes to these GPUs actually being effective at inference. So that is why there's a stranglehold in supply, and that's why the market's been able to give the multiple, but the market's not giving it like a realistic multiple that a growth stock would get on a forward basis simply because of the fact that they feel it's still cyclical. But 2026 sold out, right? So that was something that was really important. Then what did they do last quarter? They beat revenue by 200%. It grew 57% year over year. They beat EPS by 25%, and it grew 100% year over year. So you have these massive earnings updates. What is the street expecting today? They're expecting $19 billion of revenue. Let me get the exact number. They are expecting 19.5 and $8.85 of EPS. A couple people I talked to yesterday that are a little bit more rooted in the memory trade. I had dinner with one of these guys. He thinks Micron's going to bring in $22 billion and the EPS is going to be more like $11, which, you know, it's a guess. Maybe it happens, maybe it doesn't. But he thinks these numbers are going to be smashed away. The question then becomes, we got Nico right here. I know he's big into Micron as well. He says the EPS will be $10. If they do smash those expectations, by the way, these numbers that you're looking at on the screen are already implying triple-digit growth on both metrics. Not even year over year, quarter over quarter. Last quarter, they did $4.70 in EPS, which means the next quarter, not the next year, the next quarter, they're expecting $8.85. If that ends up being $10, $11, imagine if it's like $12, $13. I feel like there's nowhere to go but up for Micron, unless there is some disclosure around guidance or this or that the street interprets in a weird way. I mean, this kind of happened to Broadcom, which is why Broadcom wasn't able to hold on to its momentum back in December. I think Micron's a totally different story, but you know, this stuff happens. Broadcom, by the way, this has been a disaster. 316, it was at 350 last week after earnings. So is it priced to perfection? I would say no, because the forward PE is like 12. So it's not really, you know, Broadcom's was at like 80 in December. So it's a little bit of a different situation, but you know, the momentum in the stock might be something that comes into play when it comes to how the street's going to think about it. Then what else did they do in the last 90 days? They had their Taiwan expansion. They acquired a power chip P5 facility. They're building their second fab at the same site. They expected 20% capacity increase by 2027 to 2028. They have that $100 billion New York mega fab. And they also have the Idaho one, the Singapore one that's worth $24 billion. They have strategic partnerships with Applied Materials for focus on DRAM, HBM, NAND. They are working sort of in collaboration with all the other hyperscalers to make sure that they have an AI supply chain moat that is very tailored and specific to either custom ASICs or the GPUs that they're supplying memory for. Like Micron's done a lot, yes, the Singapore fab, in the past 90 days. And we've seen all these updates. The biggest thing that I should be bringing up is that DRAM prices have, you know, I think if I'm not wrong, in the past 100 days doubled in certain level. Now, obviously, Micron has different levels of negotiating with different providers, and for Nvidia, it's different. For Apple, it's different. But the point is, prices have gone up. And if prices have gone up, and Micron can lead to explaining that prices are not only going to continue to go up, but they're going to have the ability to have leverage in their negotiating power going out after 2028, which is kind of the big thing I think the street cares about. I mean, maybe that's gonna also create some more momentum. One thing I did hear at GTC from other people that I talked to, 70% of you guys, by the way, said dump on FOMC. You guys were right. Let's do Micron pump or dump. Is that, and this was just the general chatter based on people I was talking to in the conference, Micron's getting too powerful. SanDisk is getting too powerful. Memory is getting too powerful. It's almost like silver, right? When silver was running like crazy, like, and Elon tweeted, like, this is unsustainable. Like, you know, silver's used in a lot of industry. This thing cannot keep going up. Like, I don't care how much people think it's valuable. Like, you literally can't make a margin on most products if their cost of goods, which silver being a big one of them, continues to go up. There is the general sentiment that the big guys might come together and be like, no, like, we're not going to keep paying these prices. We don't care how much of a supply glut that there is. We are going to make sure there is a manufactured way to keep these prices down to be able to make sure that this doesn't fully play out. And that's one thing that I don't think that's going to have an impact today on Micron. I don't think the CEO is going to say anything about that. But if the general sentiment becomes that the hyperscalers are not going to allow these prices to continue rising as much as, they've been going up for 3 years in a row. So do they just keep going up, or at some point, does Nvidia step in and also say, all right, we got to slow things down. This is messing with our gross margins. And that kind of puts a lid, at least on the margin expansion, maybe not the top line revenue growth, because that'll continue to happen for Micron as there's more demand, but that margin expansion might be a little iffy. And so that's one thing to think about. But in the next 6 minutes, as the market closes, we'll get a better understanding of how this plays out. Wow, S&P 661.79. 661.79 as we see this one also taking a hit. That is down 1.33%. Again, we have 5 minutes until the market close. The main thing for today was the FOMC meeting, which we've been covering for the past 2 hours. Jay Powell, what did he say? He said the same thing he always says. We need more data, and we do think that energy inflation is having an issue on our expectations for broader inflation, which is why, I think that's why the market's getting hit right here. But, it seemed kind of inevitable the market was going to get hit off these oil headlines as they were continuing to go higher. A couple other oil headlines that just came in the past 20 minutes. We talked about the Iraq refinery that got hit this morning. Saudi Arabia also is announcing that they got hit in a couple different. So there's an LNG refinery in Bahrain that was targeted and damaged. The U.S. is saying that is because of Iran. And then Saudi Arabia says they intercepted 4 ballistic missiles launched towards Riyadh, as per the state TV. Parts of the missile fell near one of the refineries in the south of Riyadh. And those are some of your ugly oil headlines. They're obviously creating some more pain, which is causing some more issues right here. You got a couple people that are testifying. We'll look at these clips later. Tulsi Gabbard is testifying right now in Congress. We'll see some of the stuff that she's been saying. Dow Jones, that one's getting hit as well. Again, we got 3 minutes until the market closed. Dow Jones is down 800 points on the day, 46,000. We are not at 50,000. 661.86. VG is up 15% today. Rocket Lab, ugly 11% down day. Again, they did dilute by $1 billion. That's why that stock is also getting hit. And then Micron right there at 465. Let me put another poll in the chat as well. I think the majority of you, let me see what we said on pump or dump on Micron. 58% said pump, so it's about 60-40. Let me do another one, which is how many people own Micron? How many people own it? Or do you own Micron? I think this is like 70-30 in the chat, right? 70% of you don't, 30% of you do. Do we have any Trump news? No, Trump has not tweeted since Jay Powell. In the morning, he tweeted a bunch of stuff about the Democrats. Outside of that, no major updates on Trump in particular around Jay Powell. I think Trump was sitting down with one of the chancellors yesterday from some country that I can't remember because I didn't stream it. But there were some clips from that we should take a look at. It wasn't the German guy. It was someone else at the White House. Northern Ireland, right? Is the Ireland guy? I think. Yeah, so we'll take a look at that. But, that was yesterday. And once again, Trump said, I think the war will be ending soon and Iran can't get a nuclear weapon. Those are the main headlines that I'm seeing. I think the market is numb to that stuff now because who cares? Like, until you prove the war is going to end soon, as he's been saying literally for the past 2 weeks in a row, we're entering the 4th week of the war as we end out this week. I think the market's numb to it. Realistically, guys, the reason I think everything's dumping is not even because of the rate cut. It's because of PPI. Like, I think the market just needed to get through the FOMC to officially dump. But that PPI, I am still not over it. I know I missed the market open today, but when I saw this in the morning, this was disgusting. 3.4 versus 3, 400 more basis points. Like, that's not 3.9 versus 3.7. That is, we cannot be easily cutting rates and going risk on when we have this type of inflation data. So, and then you have oil that's getting hit in Qatar and Saudi Arabia and Iraq. And so it's just a messy, messy environment. Thankfully, stocks are already down a lot. I know it's counterintuitive, but because stocks are already down so much since November, they could obviously go lower, but it's not like they're trading at nosebleed valuations, definitely not the Max 7. And maybe that puts a little bit of an artificial floor, but we're going to have to see if the S&P can even hold on to some of these levels. 661 now being in question right here. 20 seconds till we close. And it will be another red day. We are not going to get 3 green days in a row for the S&P. All right. There you go. Wednesday, March 18th, 4 p.m. Lowest S&P close since November at 661. The stock market is now closed. All right. We are done for the day. Oil was up 5%. S&P 661. That was down 1.3%. Broadcom was down 2%. Meta was down 1%. Nebius was up 1.92 after they increased their dilution from 3.75 to 4 billion. Nvidia was down 1%. Reddit was down 1%. Reddit actually held up today. Which wasn't too bad. AppLovin was down 3.6%. TTD was down 6%. Robinhood down 2%. Coca-Cola, even all the value names were down 2%. Verizon down 3% as well. For those calling it a Tinkerbell, that is very rude. UPS was down 1%. Circle was up 0.5%. Grabby Grab. This one is not catching a break, unfortunately. I mean, I really have nothing to say on this until they kind of get not only the earnings to have momentum going into Q1, which is going to take a couple months, but sentiment to change. I think Grab is going to get hit. One thing I do think is affecting Grab and a lot of the other international stocks is the price of oil. And if the price of oil is going up, Grab obviously has incentives and subsidies for their drivers. If their drivers can't afford the price of oil, they might have to pay for some of that, and that could be hurting their margins, which is what the street could be pricing in. So I think that Grab, see limited, a lot of even Uber to an extent, even though Uber wouldn't really subsidize, but the cost of anything going up is what I think has been affecting a lot of these different growth stocks in different parts of the world. AMD, that was up 1.6% of the day. SoFi actually ended just above 17, unfortunately, 17.18, as that one was down 1%. All right, Micron, do we have the earnings? Micron is green. The numbers, what do we got? What is EPS on Micron? Wow, 23.8 billion on revenue versus 19 billion. That's a 4 billion beat. The stock's really not moving a lot yet. Let's see if it tries to move 2%, 3%. Now it's trying. That is a $4 billion beat. And then EPS. What is EPS? Is EPS 12 bucks? I'm trying to confirm if it's 12 bucks, dude. The street was expecting $8. Micron, 2.6%. Let me see, what was the EPS? Revenue, 23 versus 19. EPS, where the hell is the EPS? Why doesn't anyone have the EPS? I don't see it. I'm looking at gross margins, cloud. Where is the EPS? EPS. Why does no one have the EPS? Yeah, none of these websites have the EPS. Even Cactus doesn't have the EPS. You guys are saying 12.20. I'm not seeing that. Let me make sure. I want to confirm that. If that's the case, then yes, that is a massive, massive beat. EPS is earnings per share. EPS is earnings per share. They're guiding for third quarter revenue of 34 billion. The street expected 23. That's an $11 billion beat. Goodness gracious. So the guide is incredible. Again, revenue's at 23 billion. Bloomberg doesn't even have the EPS number. You guys are saying 12.20. All right, I'm going to trust you guys if you're saying 12.20. IBKR says 12.20. I'm looking at a Bloomberg doc. This one doesn't even have the EPS. That's weird. Why are they not reporting? They should just explicitly show the EPS. Gross margins are 75%, which is good. Okay, look, if we're at 12.20, that's a freaking massive beat compared to expectations. That would be a beat by 41%. Stock's not moving that much though. It's not. Last quarter it was up 20%. It's not really moving. I wonder if it's priced in. I wonder if the street's like, look, you were at 400 2 weeks ago. You're at 470. We're not going to give you that $500 level. But these are massive, massive freaking numbers. I mean, I would, even though Micron, one could argue, has done as well as it has done over the past 2 years, 34 billion versus 23, $11 billion beat on the guide. And then a 41% beat on EPS. Remember, Micron is a $500 billion company. So it's not like it's a small company now when it's putting up these beats. You're seeing the stock get a little bit of momentum, 472. It was actually up even more in the pre-markets. So it's not reclaimed those levels yet. But, it's very similar to Dell. Dell beat by 17 billion. Nvidia beat by 8 billion. Micron has had the most impressive beat on the guide, beating by 11 billion. So if Nvidia is putting up those numbers, obviously Micron was going to put up those numbers as well. It's just, they put up those numbers way ahead of expectations, even the highest expectations. But the street's not really giving it that much excitement here. That much excitement. Trying to get all the rest of the numbers real quick. Let me pull up some of this stuff. I don't know why the EPS wasn't reported with the revenue, even on Bloomberg. Yeah, this is the Bloomberg report. So I'm trying to get that exact 1220 you guys are saying. But adjusted revenue 23 versus 19, $4 billion beat. Gross margins, this is the biggest thing, I think, out of the print. That's up 5%. That means they have something called pricing power. If they can increase their, I mean, Nvidia has 75% gross margins. Micron's matching Nvidia. Cash flow from operations, 11 billion versus 8.9. That's a beat. Cloud memory was 7.75 billion. Automotive 2.7. Data center 5.69. And mobile and client revenue 7.71. That's a $4 billion beat. Also, one of their directors bought 7 million worth of stock at 370 as well. So you did have some insider buys happen at Micron. That happened last month, which, you know, probably those directors felt the numbers were going to continue to impress. Wow, it's going red. Going red, 457. Market doesn't care. At least right now, maybe the call can fix it. But this is not really one of those stocks that is rooted in the calls. It's usually, last time it didn't move off the call either. This was really based on the initial numbers. 1% down right here. SanDisk has probably also got to be down as well. SanDisk is down 1%. Western Digital is down 1%. Seagate is down 0.5%. Now, again, a 1 or 2% drop is nothing. Like it's. I don't even want to I don't want to be overly dramatic because Micron's up like 50% this year. But after these numbers to not go up is a little surprising. It's also not the best for the broader sentiment of the market because it's exactly what happened to Nvidia. Even though Nvidia did go up, it just went down the next day. Micron's not even giving you a chance to go up. S&P also dropping after hours again, 660.75. 660.75. Yeah, see, what is going on with the earnings report? Even those of you that are copy and pasting these numbers, you guys are giving me the Q3 EPS estimate, which is amazing. That's very important information. But why is no one reporting the proper Q2 EPS? Like, why are you guys having to rely on your brokerages to get the EPS? That's so weird how it's being reported. But if you're saying it's 1220, that's up 682% year over year if it's 1220. If it is 1220, and the only reason I'm bringing this up is because maybe the algos aren't picking up that EPS beat. If the EPS is not even coming in, maybe that's another reason it could not be reacting as much. That's a little bit of a stretch. I know I'm stretching here, but the point is it's very weird that it's not widely being reported, the EPS. But if it's 1220 on the 850 expectation, that's a 41% beat, 682% year over year, which is absolutely massive. And then again, on the guide, that's an $11 billion beat. Street wanted 683%. Yeah. Benzinga was the source in IBKR. Yeah, if IBKR, Yahoo, and Benzinga are saying the same thing, then it's most likely 1220. I don't know. It's kind of weird. Usually I see the number immediately, and even Bloomberg, you're getting the guide, not the actual EPS number. But there you go. Micron right there, 459. 459. EPS is 1207 gap and 12.2 non-gap. Yeah, all right. So there you go. 1220 is what we are seeing. Bloomberg's now saying 1220 for Q2 adjusted. Okay, so if we have all the numbers, the question now becomes what's the reaction to the numbers? And unfortunately, the reaction is not necessarily in the right direction. Let's see if we can get some more coverage on Micron, and then we'll go to their website and get some deeper numbers. Put in the chat what people are thinking. Are you selling? Are you buying more? Are you doing anything with these numbers? I mean, they're unbelievable. CNBC is not even covering it. Are they? Nope. Okay, we got it. Let's see their hit on the numbers, and then we'll go a little deeper. Yes, then we'll look at D-Local. We'll look at D-Local as well.
Maker. Let's start with adjusted EPS in Q2. That came in at $12.20 versus the $9.31 expectation, which was already a 500% jump expected going into this. That's on revenues of $23.86 billion versus $20.1 billion expected. That's a 3x jump year over year. Jumping down to Q2 non-GAAP gross margin, this is a really closely watched metric across the chip sector. That's coming in at 74.9%, beating expectations of 68.9%. And then looking ahead in terms of Q3 guidance for EPS, $19.15 plus or minus 40 cents versus $12.05 expected. Revenue guidance for Q3 also a beat, coming in at $32.5 billion plus or minus 740 million versus $24.3 billion expected. So a really significant beat across the board. But Micron coming down 1% right now. I'm digging into this report, Mel, and I'll come back to you with more.
All right, Mac, thank you. Mackenzie.
Yeah, even CNBC is confused. They have the 1220 number though. So okay, so that number was reported. I guess I just didn't see it in the places I look at. But 1220 was EPS. So even with that number, the street was not excited enough to get this thing to move up. It's going a little green, but dude, this type of a beat, gross margins up 5%, EPS beat by 41%, revenue beat by 22%, the guide beating by $11 billion. Cash flow from operations beat by $2.5 billion. For that to get faded is, I guess you chalk it up to the stock was 60 back in April of last year. It's at 460, and people cannot be upset about it. Unless you bought it today, you can't be too upset. And even if you did, you're getting a little bit of an after hours move, a little 2% move, unless you bought it at 470. If you bought it anywhere below 465, you're still getting some juice. VG moving up again after hours as natural gas prices continue to climb and as oils continue, as oil continues to go up. It was priced in already? Okay, but they demolished these numbers. I don't know if this type of a beat was priced in. Like the street was expecting 19 billion. Street maybe thought they would do 21, maybe 22.50 on the whisper. They came in at 23.9. I mean, that's an Nvidia type of beat. Once again, obviously macro's in a bad space, but I don't know if that was priced in. I don't think Nvidia's beat was priced in because again, it was just so damn good. There's no way you could you just don't think they could actually get those numbers, but they did. S&P right here, potentially losing 660 after hours. I guess it just wasn't enough. Micron, the fact that it's even green after hours by 1% is surprising given everything else is going red. Robinhood's red, Trade Desk is red, AppLovin's red, Q's are red, Nvidia's red, Nebius is red. SPY is red. Bitcoin just lost 500 points, 71 to 70.5. Yeah, basically in the past 7 minutes. At 4:05, it was at 71. At 4:12, it's at 70.5. IGV as well, going red. Oil is spiking. Oil is spiking. You guys are right. Crude is at 98. Is that correct? Oh, shit. There had to be a headline just now. Oh, there it is. Iran fires fresh wave of missiles at Israel. I think that will do it. Now, again, that's not exactly an oil headline, but that's more escalation of the war, which is bad. The Saudis just came out. They said we foiled a second drone attack attempting in a strike on one of the gas plants in the eastern region. One of their facilities near Riyadh already got hit. We reported that about 40 minutes ago. And then you have this one. Iran fired a fresh wave of missiles at Israel. Red Cat earnings, we have this as well. They missed by 13% on EPS. Negative 17 versus negative 15. Revenue was 26.3 versus 23.2. Red Cat is down a little bit. Not really much. Down 0.17. Down 0.17. Red Cat's up a lot today, so I don't think that's going to create that much pain. They've been already firing a lot of missiles. Yes, that's fair. It's just, again, the escalation or the de-escalation of the war being priced in, or any perception of that being priced in whenever those headlines continue to, stack up attention. I mean, yeah, it spikes up oil, which obviously creates this pain. D-Local is up 8%, so we didn't look at their earnings. Let's see what they've got. This is a payments company, I believe, in Latin America. I know they had a really good earnings last time, but they fell. Beat by 14%. EPS 18 cents versus 18 cents expected. EPS is up 80% year over year. Revenues up 65%. 337 versus 296 on DLO, as that stock is up 8%. Okay, that's what we got, folks. That's what we got for earnings, and that's what we got for Micron. Nothing too crazy based on these results. Micron, again, basically flat right here after hours. S&P 500 is down. Micron is at 466, up 1%. A monster beat. Has not been able to really get that much excitement. But, I mean, if you have Micron, I mean, put in the chat if you're going to hold on to the stock after these earnings. Obviously, your cost basis determines that as well. But, man, this was one of those quarters that I think the street definitely was excited to see, but they're not giving them the price action. Let's bring on a guest onto the show. We do this every time we go to one of these events. And so let's get his thoughts on what's happening in the market. Ladies and gentlemen, we are joined again.
What's going on, guys? What's going on? How you
by
guys
Stock
doing?
Talk. And you have Angelo in the background as well. Some of you guys know Angelo if you were at the New York meetup, but a lot of you guys probably don't know him as well. Dude, what's up?
Chilling, man. Doing good. I mean, obviously, interesting day in the markets. Most of the major indexes read. Quite a few stocks managed to shrug off the selling, though, and do pretty well. OSS earnings were this morning. I was up very early for that. I thought they were excellent. Managed to close green on the day. Had quite a volatile day. I think it opened down 8 or 9%.
And then it went up 12%. Then it went down.
And then down. Yeah, then it was up into the 11s and 12s. But, you know, that's bound to happen with these smaller cap stocks.
Dude, you guys are crazy, bro. We just like we're investors. We're supposed to be mature.
Yeah, I know, right?
And
Come on,
normal.
guys.
You
Yeah.
guys, for those that were at the New York meetup, you met Angelo. Angelo is also be at the LA meetup. He's helping out with all the meetups and stuff. All right, so let's talk Micron real quick, and then we'll get into all the other stuff we got going on. And then I want to ask you about GTC. But you saw the results. Stock's not pumping. Is this kind of? I mean, you talked about it yesterday that you think the stock's going to be flat. Is this just what you thought would end up playing out?
Yeah, I mean, I just think it's a hard environment to get traction off of, even good results. I mean, we've seen a lot of, I think, good reports get dumped in this earnings season. Appetite for risk is not as high as it was last year, obviously, or even the year before. We've been in a pretty strong trending bull market for a couple of years now, but it's starting to shake. You know, there's a lot of geopolitical pressure built up. I think now monetary policy path is a little bit more uncertain than it was just a couple of months ago. Economic data certainly hasn't gotten better. Jobs market has gotten weaker. So there's quite a bit of uncertainty on the table now that there wasn't like a year ago. And I think that's probably contributing to the lack of follow through and momentum and a lot of these earnings reactions. But it was a great report. I mean, I don't think you can fault them for anything in that report. To be honest, it was a pretty excellent earnings result.
Yeah, I think the interesting thing about it as well is that as bullish as it was, and it was even bigger than Nvidia in terms of like the pure amount of dollars they beat by, it's the same reaction as Nvidia, which gets into the conversation around GTC. Do you think you heard anything here? You're not an Nvidia investor, but obviously you track the AI space very well. Amcor, a lot of people invested because of Stock Talk bringing that idea that is a very important derivative of Nvidia, TSMC. Did you hear anything at this conference that keeps you excited about the AI trade? And do you feel more confident having money allocated in these AI investments?
Yeah, I mean, I don't think there was a ton of alpha at GTC, like not a ton of new information really, but just a reiteration of the things that we know are happening. AI at the extreme edge, AI and physical robotics applications. I think Jensen had a lot of focus on the whole AI factory vision at this GTC, which is really more relevant to NVIDIA than anyone else. But there was a lot of emphasis around pretty much all of the major themes that have already been active this year, photonics, edge AI. They're not going to talk a whole lot about things like on-device inference, obviously, because that's not a category that NVIDIA is involved with yet. I think they will be at a certain point. But there's a lot happening, I think, on the supply chain side as a result of all of this momentum in AI factories and the idea that more and more people want end-to-end services built in when they're buying this stuff in the first place. They don't just want to buy the GPUs and then figure out the rest themselves. They kind of want an end-to-end product. And so I think that's expanding the supply chain opportunity, which is obviously where I'm focused with a lot of the mid caps I look at. So that I think is interesting, but there wasn't really a ton, I think, at this week that blew me away or like new information that I thought was going to provide a lot of alpha. So
the OpenClaw thing was the only exciting part, right?
Yeah.
This agentic
Yeah,
stuff.
that was
but
cool. Yeah.
FSD partnership with Uber, like all this shit. Honestly, if you've covered GTC, you've heard it a million times, and I think that's also why it was a bit underwhelming. The $1 trillion number. What was your reaction to that?
I think that's obviously just like a big number to use, and I think he wanted to use it because of that. But I mean, it wasn't really far off from buy-side expectations for what Nvidia was going to post in those 3 calendar years. And I think a lot of people misinterpreted it when they heard it to mean that he was saying they'd do $1 trillion in revenue in 2027, which is not the case. He was talking about a full 3-year period. So I think, I don't know, I don't think you can look at that and say, it's something that blew expectations out of the water, because it didn't. And I think that's part of why the stock didn't respond to it. It's a big number, but it's not, expectations are high for them, and for good reason, because they've been executing. But I think at a certain point there will be, I think even Nvidia will hit a wall at a certain point in terms of this idea of unlimited demand, because there are alternative products emerging on the marketplace. I mean, their acquisition of Grok with the LPUs was really in anticipation of this, that it would be a competitive product with them for inference. And so now they're embedding it into the NVIDIA ecosystem. But you think about all the developments this year, Broadcom's ASICs, Google's TPUs, right? Amazon's Trainium chips, et cetera. All of these are potentially competitive products that just haven't gotten any traction yet, because NVIDIA's arguably 2 generations ahead of the pack. And that's really what's giving them the advantage, I think. And if they continue to innovate and iterate the way that they are, they'll probably continue to enjoy that advantage for some time, until you hit the replacement effect, which Jensen said is a decade away, according to him.
Do you believe that? Because I feel like...
I don't know. That feels dragged out. I don't know. He said 99% of demand for Rubin is going to be incremental, which is... I mean, I have no choice but to believe him. Obviously, he's not. I don't think he's lying to a room full of media, but that's hard to believe. And even if it is true, then how long does that last? I mean, 3 or 4 generations. He's at 10 generations of chips until they see a replacement effect. That's difficult. That's difficult for me to wrap my mind around. And I think that even more than before you see an NVIDIA replacement effect, I mean, eventually AMD right now is having to bribe customers to buy chips, basically, with the Meta deal, which is sad.
I never heard someone use the word bribe, but it's true.
That's what they're doing. Yeah, I mean, they're bribing Meta to buy their chips, in return for warrants and potential equity. But that's just a demonstration of how far ahead of the pack NVIDIA is. Now, I think on the other side of things, like on the inference side of things, I think Broadcom's ASIC program is pretty interesting. I think Google's TPU program is pretty interesting. The thing is they're not general purpose compute the way that NVIDIA's GPUs are. And so that does make them less competitive to NVIDIA's reign when it comes to the entire ecosystem. So they're in pole vault position to continue to be leaders. I just don't know, what more the market wants from them. Obviously, the expectations are really high, and so what was said here at this conference just wasn't enough to move the stock.
Okay, stock talk is now pillow talk is the funniest one. There's some good ones here, but that.
Wait, have you not had that in the background of your stream for the whole thing?
I have, but I guess they I was sitting where you were, so they didn't see.
Oh, okay.
They didn't see the messiness of the bed, but now they see 2 guys.
Don't worry, guys. We're not staying in the same room, guys. Don't worry.
I paid him to say that, but anyway. Actually, no. There's stock talk. You can follow him right there. All right, so we have a lot of topics I want to get into, particularly around OSS, photonics, some new themes you're looking at. But let's talk general macro. Yesterday, we were kind of talking about, is there a world in which we could bottom? Because S&P was pushing 675. We had some thoughts about, hey, maybe oil Trump says, hey, war's over, oil goes down, and then boom. Like, what is the framework for a bottoming process, you think, right now?
Well, it's certainly not PPI numbers way above expectations. And then you get Jerome Powell coming out and saying we're probably in a more uncertain position than we have been in quite a while. And the PPI miss, keep in mind the PPI data we're looking at is from February.
Yes.
So
doesn't have the oil pump yet.
This doesn't even have the oil pump included in it. And producers were, maybe positioning for what was a well forecasted conflict. I mean, U.S. strike groups were in the area for a while, but oil doesn't seem to be wanting to go down. You had that big fade going into Monday, and then now it's back at what Brent's at $1. I saw it at $1.09 this morning. I don't know what it's trading at.
107.
Yeah. So you don't want a market where you were supposed to get rate cuts. You had all the AI hype and narrative going. I mean, people were going from memory to photonics to kick off the year, and those stocks were mooning. So you still had a lot of excitement around the AI trade, especially in the supply chain. And then you get not only a slowdown in rate cut expectations, but you get some pretty bad labor market prints.
Yeah.
And then you get some pretty bad inflation prints. And
Micron dumping now.
And now you have, they must have said something on the guide. And now you have a dynamic where the market was expecting this to be a year where we saw policy easing, and instead we might just get policy stagnation as a consequence of everything that's happened. So, and you pull up the index charts. I mean, you can pull those up on the chart thing. Pull up SPY and QQQ on the daily charts. I mean, they don't look good. They're coming into the 200-day moving average. Maybe you expect some buyers to step in there, but I mean, you rewind back to the flash crash in April of last year, and we knifed right through it, right? And so it's going to be tough to catch a bid, I think, without a catalyst in this environment. And maybe that catalyst is
so do you think Trump? Well, I also want to get your general thoughts about the war. You can get political if you want, or if you don't, it's just keep it economic. But I mean, do you think we needed to do this? And then how do you think we get out of this? And what does the market do in the meantime before this all ends, if it ever ends?
I think the only way to get out of this scenario that you're in right now in terms of market pressure is to get the strait open. So I don't even think the conflict needs to end. The strait just needs to be open. And maybe that involves the U.S. withdrawal. Maybe that involves control of the strait somehow. I think right when I was walking over here, there was a headline that came out. I think it was like Trump is planning on taking control of the strait, something like that came out when I was walking over here. But that's one option. I mean, you take control of the strait, or you leave the region, or there's some other form of de-escalation. But the market doesn't care about bombs being dropped. I think that's what a lot of people are misinterpreting about this conflict. Like, people are like, oh, everyone says war is not bad for the markets, and like, now look at what's happening here. But that's just that's like a rudimentary comment to make, because the market doesn't care that there's war going on. The market cares that the war is affecting commodity. That's why the market cares.
So you don't even care about the politics of it. You're just looking at.
oil. If the question is from a market lens, what matters? That's what I'm speaking to. It's less about what my personal political view is on it. It's mostly about what does the market want. I mean, and some people may say, take the pain in the market for accomplishing a strategic objective. That's fine if that's your opinion. But if you want the markets to go back up, that's what you need. You need the strait to be unclogged. And that's, I think, a tall task. The U.S. could just literally leave the region. Like, we could just get our carrier strike groups to leave, and that may open the strait, but it may also not. The Iranians might just say, you know what, we're enacting our revenge either way by wreaking havoc on the global economy. That may just be the Iranian position. I don't know. I'm not a strategic advisor to the Iranians or anything, but unclogging the strait would get the market to rip, I think.
Okay, so that is the catalyst for the market to move up. Let's talk about like a really bad case scenario. S&P, what's your level? 6,000? And what do you think gets us there?
I mean, I think, let me pull up my charts, because I don't love your charts.
Micron, by the way, guys, is definitely getting hit. We're not going to be listening to the call.
You must have said something, though.
Street's not excited about it. Micron down 3%, which again is not crazy, but after those numbers.
Let me see here.
This might have been the headline you looked at as well. Trump waives shipping rules and plans talks with oil executives as markets remain on edge.
That might have been it. Yeah. That might have been it. Yeah. So I'm look on SPY. Man, this is ugly. I mean, really, the 200-day moving average is sitting at 657, right? So we're trading 661 as of today's close, 659 after hours. Then you have a monthly 9 EMA down at 660. So this would be a great spot to stop. And this would like literally where we are would be a great spot to stop. But if we don't, you may get a really brutal unwind, a capitulative selling. I think this is kind of the line in the sand where we're sitting here, 659 to 660 on SPY. You would like to see markets bid that up tomorrow. If we don't, the weekly chart looks like it's in for a bigger breakdown. And the same thing goes for the Qs. I mean, the Qs you're looking to watch is 591. Qs are trading 594 as of today's close. That's a big area of support. If you break that, you're probably going lower. But it doesn't mean you're going lower sustainably either. I mean, if you go back to April, we flash crashed to 471, and within 4 days, we recovered most of it, right? So it's really about if you want to have a Band-Aid pulled off kind of moment. Markets are setting up for that, as shitty as that sounds. And I mean, I'm somebody that's now long on the markets too, so it's not like it's something I want to see happen, but markets are setting up for that.
What would get you to start really raising cash? Because you're not there yet. You're like fully in.
Yeah, I mean, I'm not fully in. I have like 5.1% cash. As of tomorrow, I will probably have a lot less than that because I have options exercises coming up. Not tomorrow, sorry, on Friday. I have some option exercises coming up that I am going to exercise. So I don't know. I don't know what the cash position will look like by the end of the week, but I'd ideally like to keep some.
Would Trump have to say like this is not ending soon for you to be more scared, or would that be him bluffing and you're trying to read between the lines?
I wouldn't really treat my risk tolerance in terms of what Trump says, because that's a really, really hard thing to track. I mean, he's going to continue to say, I think, whatever is politically expedient at this juncture. I don't even know if he cares about what's politically expedient, because I don't think this decision was particularly politically expedient. But it wouldn't be a political commentary that gets me to get really defensive. It would be a technical breakdown that doesn't get bought back up. If we break below the 200-day and we don't see pretty immediate signs of recovery, that'll get me to reduce exposure pretty dramatically. That'll also probably get me to take off almost all my options exposure. My options exposure has gone down a lot in recent weeks. I had something like 15% of the portfolio in options. That's now down to 6. By Friday this week, it'll be down to like 4 or even less than that. So that's one way to reduce volatility in the portfolio, or that I'm using. And the other way is just to reduce exposure overall, which is a step I will take in terms of the position count. I will take that step if markets really do decide to break down below the 200-day and there's no signs of recovery.
Do you think the broader AI Capex trade, I know we talked about Jensen saying it the last 10 years, but do you think there could be a crack in that soon if labor market goes down, multiples compress, recessionary types of comments come in, and then Meta says, well, we're going to spend a little bit less on CapEx? Or do you think there's just no world, because they were so committed to this AI story, where they would rather fire people before spending less on CapEx?
They would definitely rather fire people before doing that. That's certainly the first step they'll take. I just think there's too much incest in the data center spend. Like there's too much market capitalization riding on it, and there's too much momentum in the overall markets riding on it, that I think there's sort of an unspoken agreement between, and by unspoken, I mean literally unspoken, as in they don't even mention it in interviews, agreement between Microsoft and Oracle and OpenAI and Anthropic and all of these guys to say, like, and Nvidia especially being at the top of that, to say, like, look, we are not going to waver from our CapEx commitments, even if we have to dress them up, even if we have to put lipstick on a pig, and rephrase the commitments or reallocate funding or change the name of a project. they really started doing this when Stargate started, and they announced I can't remember what the number was, but they announced some specific number in the very first article that ever came about Stargate. And I remember I went back and did the math, and it was the sum of all the agreements that were signed prior to Stargate for data center funding.
So it wasn't
and so
even
they
like
just
yeah.
it wasn't even a new thing. They just added up all the commitments that had been made already to OpenAI, and then put lipstick on a pig by saying this is the Stargate project and it's going to have $750 billion in funding. But then if you went back and added Microsoft's and so that's, I don't like obviously the look of that. That doesn't come across as genuine, but I don't think they can step away from it. I think
leading the circle jerk is
the circle
intense.
jerk is too important. Yeah, the circle jerk is too important. And the circle jerk between all of these guys, if it ends by one of them saying, we're slashing data center spend in half, it will be a domino effect.
Yeah.
It'll be a domino effect. And you will see a crazy compression in multiples, I think, if that happens. So let's hope that doesn't happen, because if you add that to the mix in this kind of market with as many wrenches as we have in the mix already geopolitically and in terms of monetary policy, that will really wreak hell on the market. So you don't want to see that happen.
Yeah. By the way, guys, we are not listening to Micron. So if you want to listen to it, you can listen to it, but there's not much to get. I mean, we saw the numbers. I'll get the highlights. We'll talk about it tomorrow, but we're not going to listen to them speak for an hour, but we will try to get the highlights from it and talk about it tomorrow. Okay. So let's move on to some specific themes. I want to talk about this because this has been blowing up on X. You're obviously a very big creator on X. Again, Stock Talk putting his link right there. Photonics. This thing has taken off. You actually played a lot of these names early in 2025, AAOI, Light, Coherent, etc. Is this a little too hyped? And are people crazy to say this is the next memory supply chain bottleneck?
I did trade those names early in 25. I traded them quite a few times over the last couple of years, actually. I obviously didn't hold them for long enough. I wish I had held, especially Light, had held that for longer. But what I'll say about the photonics bottleneck is that it's very different from the memory bottleneck, because the main thing that matters in a bottleneck is ability to bring incremental supply online. And it's much easier to do that in photonics than it is in memory.
Yes.
And so that does affect the thesis. Now, that being said, memory is also traditionally cyclical and has been in the past. Now, that's the cyclicality of the memory business could be breaking the same way that the cyclicality of a lot of the rest of the semiconductor industry is breaking now. So I don't hate on the memory bulls, even though I'm not exposed to memory in my personal portfolio. I don't really hate on the memory bulls because I get the thesis there. I understand what they're saying, which is that, look, you're going to have a very extended cycle this time. You're going to have a bottleneck that lasts a lot longer because it's going to take, just to build the clean rooms. I mean, we were talking about this at dinner last night with some people. To build the clean rooms for memory that are needed for memory, additional memory capacity, you need 1.5 to 2 years for just the clean rooms, let alone the actual production capacity. And so that is important to keep in mind. It's important to say, all right, it takes longer to bring capacity online, so the elevated valuations, the multiple expansion you're seeing in memory is more justified. But then when you look at photonics, it's not such a simple equation. It is easier to bring supply online. Supply can be brought online in a matter of months instead, because it is a very legacy-oriented business in the telco side, and you have plenty of legacy supply. Now, there are aspects, for example, about the laser fabbing that AAOI does that does make it a little bit more interesting and does give them a little bit more juice. But then on the other side of that, they have a history of really, really sketchy management projections that either haven't been met or have been disappointed. So there's things to weigh on all those stocks, I think. Do I think they're getting a little long in the tooth in terms of valuation? Yeah, but if they can keep up this type of growth, then it won't really look expensive in hindsight. So I don't hate either of the trades, but I do think the dynamics are different in them. And I think a lot of the comparisons that are being made between the photonics and memory bottlenecks are not accurate. And for those of you that don't understand these industries, you can just ask, ideally a pro model LLM to explain to you the difference between production bottlenecks in memory and photonics, and you'll get a pretty rapid idea of what I'm referring to here. If you don't believe what I'm saying, you can verify it pretty easily just through an LLM. So there's a much bigger lag, is my point, in memory production than there is in photonics, and that matters. It matters. I'm not saying it doesn't mean the photonic stocks can't keep going up. That's not what I'm saying. I'm just saying the lag in production matters because the longer the production lag, the more premium the people that can service the production shortage deserve.
Right.
That's just basic logic. So, yeah.
Yeah, for those that don't know, Stock Talk is crushing it this year. He's up 55% year to date, which obviously in the midst of the chop.
A lot of chop, but yeah, it hasn't been an easy 55%, but yeah, we are up.
Yeah, and so so part of how this has played out is based on holding high conviction themes in different thematics, which has kind of been his core way to manage the portfolio. Let's talk about one of those themes: edge compute, OSS. A, do you think that theme is still an important theme? B, did you like the earnings that you saw today?
Yeah, I love the earnings I saw today. So one big thing that a lot of people were missing, I think it's probably some of the sellers that were missing this morning, who were selling into the weakness this morning. What a lot of people missed about it is that they divested not one of their subsidiaries, a subsidiary that made up a huge portion of their revenue. They divested it at Bressner. Yeah. They sold it for $22 million, and when they sold that unit, it's impacted both their revenue forecasts, obviously, and their projections. And so projections and estimates were all over the place on different sources for this name. That also happens because it's a small cap and there's not a lot of analyst coverage. So that had people confused this morning. But the bottom line, these are really the numbers that are important. So in Q4, their revenue was up 70% year over year. Okay. Now, their revenue is clumpy, and so you can't necessarily extrapolate that and be like, oh, they're going to keep posting 70% growth. You can't really contextualize it that way. But nonetheless, on the fourth quarter numbers, the revenue is up 70% year over year. And their gross margin more than doubled. Their gross margin went from 26.5% to 58.5%. Now, they cited specifically that was from selling a large quantity of higher margin products, right? And that's exactly what the focus is and should be for them. When they sold Bressner, the idea was to become a pure play on edge compute. And even on the earnings call today, their CEO said that. He said, we have become a pure play on extreme edge compute. Now, this is another thing I was talking about at dinner last night with a bunch of people, and this idea that, what is preventing Oracle and HPE and these guys from competing with OSS? And the answer is nothing except scale. Right? When you're talking about these military ruggedized compute contracts, you're talking about $500-600 million contracts, in some cases $1 or $2 billion contracts. These larger clean room server companies are not incentivized to compete in that category. They're not incentivized to allocate resources or innovation or R&D or anything to compete for a couple $1 billion. It just does not make sense to them. They are competing for these $40-50 billion projects that are being done by hyperscalers. That's the money they're competing for. And so that gives them a niche to operate in. And that's what they're proving they can do with these numbers, right? So gross margin more than doubled to 58.5%. They also had their first positive net income quarter in many years.
That I was surprised by.
Yeah, and so they posted a 16-cent EPS loss last year in this quarter. And this quarter, they posted a positive 8% EPS gain. And so they had first positive net income inflection, massive revenue growth, margin improvement. And when you look at the Q4 margin improvement, the jump to 58.5%, it was better than the full year for 25. Because full year 25, they posted a 49.6% gross margin, which was up from the prior year. In 24, they posted 36%. So for the full year, you saw material gross margin improvement, 12% gross margin improvement. But in Q4 alone, it jumped to 58.5%. So there's an acceleration happening in what is already a rapidly growing gross margin profile. And in 25, their overall revenue on the year, even though Q4 you saw a 70% year over year gain, was up 31%. Yeah. And so they're guiding for another 25 to 30% growth year this year. And, there's a potential here for them to become treated as a pure play and get a pure play multiple in ruggedized compute.
And the market is shifting into caring about ruggedized compute, edge compute, a lot more than just the cloud providers.
Yep. And two of the only analysts that cover the stock from Roth and from Alliance Global both raised their PTs to 13 today from 9 on that earnings report.
Wow.
So the professionals, I mean, I consider myself a pretty professional analyst, but the actual professionals, they like the report as well. And so I think once you take into account the divestiture of Brezhnev, the purity that they're benefiting from, and the idea that they're actually executing very well, and the company has little to no debt, I think it becomes a prime acquisition candidate even potentially at this valuation. And even more importantly than that, if they don't, it's a company that could grow revenues materially in the next 2 to 3 years. They have a shot to double revenue in the next 2 to 3 years. And if they win one contract in the Army 360 situational awareness program, just one contract, it'll be a sole source contract worth $200 to $500 million. And the market cap is $220 million. So, I only own 2 small caps in the portfolio. I own 18 stocks, 2 small caps. This one and MITK, which I covered MITK on Equity Edge a couple weeks ago.
Yeah.
Those are only 2 small caps in my portfolio out of 18 positions. And when I do own a small cap, I try to make it something I like a lot. And this is a name I like a lot. So I didn't sell any today. I mean, I own it at 470. The stock traded in the 11s today. I didn't sell any. It's a name that I'm going to continue to hold. And I like it a lot. I liked the report a lot today.
I want to get your reaction to this headline, just generally what you think. Israel identified U.S. preparations for a possible military operation to take control of the Strait, which could extend the war. So that would extend the war, but that would get oil presumably to come down. Would that be a bullish or bearish headline if that was true?
Yeah, I don't know if that'll get oil. I mean, I don't get oil to come down in the immediate term, but I don't really understand what the implication is there, which extending the war. I mean, I guess that means they just expect Iran to continue to fight for the Strait, really, is what they're implying, I think.
Is there a world where the U.S., I heard this theory yesterday, just takes Karg Island, just straight up, colonizes the island and controls it? And
I don't.
Because it was floating around that at this point, if they're going to go to war and they're, trying to deal with oil prices, they're going to have to get control, not only of the Strait, but of Karg.
Look, I really like to think about geopolitics from a game theory standpoint. Like when we were in Iraq and Afghanistan, why did we not annex any land on the way out? But why? Well, the answer is because it's dangerous.
Yeah.
The more Americans all of our bases in the Middle East are in allied territory, right? From Gulf states that will cooperate with the United States.
Yes.
That's where all of our personnel are, right? And so then we put the burden on the attacker to attack those countries in order to attack military bases. Oh, you have to bomb Qatar, you have to bomb Saudi Arabia. That's the strategic intention there, right? I think the reason the United States has not annexed any land in the Middle East or colonized, if you will, any land in the Middle East is because of that, because we know there would be an open fire target for missiles in the region. And that's a way to leverage that's a way to leverage against us, right? We can bomb your, U.S. Karg Island, which would be in that scenario. We can bomb it and hold the United States, quote unquote hostage. So I don't think it's a good idea.
Do you think the U.S. is serious about regime change, or not really?
I'm not sure it's the United States that's serious about a regime change, but the coalition is what the way I'll put it. Yeah, the coalition I think is serious about regime change. I mean, I don't think it's very effective to have his son in power. Now that you did that, it seems like it's a pointless exercise if his son is in control. So, I don't think the United States wants it, but I do think, Israel wants regime change. And as a consequence of that, we will probably end up fighting a regime change war.
Let's talk about Nebius. You got this stock at 20. Stocks call it 120. You're really bullish on it. You think it can go up a lot more, but you wouldn't buy it at these levels. It's one of the most talked about stocks on X. If you think it's going up, why wouldn't you buy it at around 120?
That's how I think about stocks. So I know I shook a lot of you last time on the stream when I said I don't DCA. There's a lot of things I do to protect performance, but I could scroll through my portfolio today. Like I said, I own 18 names. I could scroll through my portfolio today, and out of those 18 names, probably 15, even though I own them, I wouldn't buy at these prices. And a lot of people ask me that question. I don't get that. You own the stock, you're holding the stock, you have exposure to the stock, but you don't want to buy more at these prices. So, do you think it's going down? No. it's never, those decisions to me are less about the individual stock and more about the swings in the market. I know, after having played this game for my whole adult life, I know that there are moments every year, and if not every year, certainly in every market cycle, where everything goes down.
Yeah.
Indiscriminately, right? And that is when I like to deploy capital. I like to deploy capital when markets are at a local low, not when markets are either chopping or ripping or trending up. And for example, last year, I deployed a lot of capital in May. So I waited for the crash to be over, right? The April flash crash. I waited for that crash to be fully sold out, bottomed out. Then I waited for the indexes to recover. And once the indexes were back in what I felt was favorable short-term structure, which was May, the first week of May, I started buying stocks.
Which means you didn't get the bottom, but you were okay with not getting
Yeah, I never get the bottom. And I think that there's this idea, I think one thing that screws a lot of traders and investors over is this idea of like, I have to sell the top and I have to buy the bottom. I almost never sell tops and buy bottoms. I'm up 55% this year. I was up 505% last year. I was up 260% the year before that. I never, in any of those years, caught a bottom and sold a top, like perfectly.
Yeah.
Instead, what I do is I wait for markets to show me signs of recovery, and that's when I become a buyer. So markets show me signs of recovery off a local low, and that's when I become a buyer. What did I buy last May? A lot of names that went up a lot. Viavi. I don't think Amcor was in May. Amcor was, I think it's September.
Yeah.
But
did you buy Hood?
LEU bought at 96 in May, right? That went up to the 400. It's trading in the 200 still. I'd have to go back and check, but I bought several. AVAV was in December, and then I sold those contracts. But there were several names in the first week of May that I bought. I think the most notable for me was Nebius, which I bought at 23. And, now I have that cost base at 23. In the next market crash, I may very well be a buyer of Nebius.
Yeah.
In the next market crash, I may very well be a buyer of Robinhood again. But at these prices, I'm not buying either of those stocks, even though I'm up 5x, 6x on the cost basis from those names. I don't accumulate positions into strength. I try to build positions when I feel the stocks are at extremely good values and build those positions rapidly, and then I hold them, and then I buy other stocks in the market that I think are bottomed out or at good prices, and then I do the same thing and rinse and repeat. And some stuff is sold and some stuff is held for years.
Do you think the capex on a Nebius, CoreWeave, Iren, et cetera, is a detriment to all these big deals they get, or do you think that's part of how those companies have to grow?
Wait, what do you mean?
So like they got a $27 billion Meta deal.
Yeah.
2 days later, they dilute by $4 billion. Like,
Yeah.
is that a game that you think is sustainable for these neo clouds? And there was a short report that came out on CoreWeave a couple of days ago, just saying like this is an unsustainable model of business. Or do you think inevitably if the ROI is there, those clouds?
No, I mean, no. I read that report too. I look, I'm not a huge fan of CoreWeave. Nebius is my favorite name out of these like sort of AI cloud names. But what I'll say is that I don't view it much differently than like operating burden, right? Like you're securing a multi-billion-dollar contract, and then you need a couple of billion to fulfill it.
Yeah.
What's wrong with that? I mean, that's business, right? I mean, if you have like if this was happening in another type of model, right? Like for example, in a logistics model, okay, this happens frequently in logistics models, okay? You'll get Nike to come to a warehouse provider like GXO, for example. GXO Logistics, one of the stocks I talked to you guys about last year. You'll have them come to GXO, and then GXO will say, okay, Nike's going to sign a $2 billion contract to manage and outfit warehouses, right? For the next, whatever, X amount of years. Then Nike will say, this contract is worth whatever, $500 million. Then GXO will go and lease the necessary tools, warehouses, equipment, whatever, to fulfill that contract. And let's say it costs them $200 million. Then they keep the $300 million. That's what Nebius is doing. I mean, it's an operating model. It's maybe not the best operating model, or you may think that it's highly dependent on data center spend, but every operating model in the world is dependent on CapEx from somebody.
No.
right? I mean, it's funny with AI. We pretend like AI, because it's a new industry, has these unique rules and unique risks. Like any industry is dependent on CapEx spend from the people who provide the CapEx, right? Like that's where it comes from. And that's where the money from the top of the funnel comes from, is the people that are providing the CapEx. So if the CapEx stops, yes, it's a risk to Nebius and to everyone else in the ecosystem. The same way it is if construction CapEx stops and, you know, industrials get hit by that. Like it's the same concept. So I think it's kind of an unfair light that AI gets painted in, especially the data center industry. This idea that like, well, all these guys CapEx, that's what it matters on. It depends on it. Well, yeah, of course, but it's the biggest CapEx category in the world right now. You know, that's where everyone's spending their money. So yeah, I mean, of course it's a risk, but no way to know if and when it'll materialize.
All right, so we'll do 10 more minutes. If you have a question for Stock Talk, put it in the chat. We'll do some rapid fire. But hopefully you guys enjoyed this again. I'm putting his Twitter in the chat. He's been on the channel like 3-4 times now. At least once a month he comes on. So we will definitely get him on more often to talk to everybody about how he's thinking about the markets. One question I saw, Oracle, which is interesting because you've been thinking about that. General thoughts on that name?
Yeah, there was a lot of talk about Oracle this week. You know, I was looking at it. The valuation feels pretty reasonable here. Now, I mean, obviously there's a ton of debt dynamics that need to be explored, but I have been looking at this one. You know, it's down like 22% year to date. I think if the AI trade, you know, is something that turns, then yeah, this one's going to get hurt. But going into the OpenAI IPO, assuming that does well, I mean, I don't know how much gas is going to have to come out of markets before those IPOs are willing to be issued. But yeah, I have been looking at Oracle. I've also been looking at Dell. I've been looking at both of those. Yeah. I don't know. I just think these massive server players have a pretty one-to-one scaling opportunity with the rest of the AI trade, and I think they're trading at pretty reasonable valuations, you know, all things considered. So yeah, I'm not a big large cap guy, as you know. Most of my portfolio, almost all my portfolio is mid caps, and so I'm always hesitant to pull the trigger on these larger market cap names, but I have been looking at both of them this week a little bit.
What have been some current buys for you?
Some recent buys. I haven't bought anything recently. I mean, the most recent buy was MITK, which I shared with you guys on Equity Edge. I don't know if I guess not everyone on the stream has listened to Equity Edge, but I have a thesis on MITK on my page as well, on my X page. If you just type in MITK into the X search bar on my profile, you'll find it. But that business is really interesting. It's a legacy check verification and mobile deposit business that isn't really interesting, but they have 99% market share. I don't know if anyone's ever used mobile deposit before, but the reason it's interesting is because the biometric stack that's required for that technology and the biometric stack they've built is now being used for AI fraud detection and identity solutions, deep fakes, fake voices, fake video, fake images.
This whole Net and Yahoo thing, dead or not, like that stuff's just getting more.
It's getting worse and worse. And so they already have the distribution rails for every major bank in the world through their mobile deposit program. Like I said, they have 99% market share in that category. And that gives them a unique opportunity to scale their fraud and identity solutions segment through to those same customers as AI fraud becomes more and more of a problem. And so that's a theme I've wanted exposure to. I was trying to find a pure play. I couldn't find one. I was looking at Clear Secure for a while, but they don't break out their fraud and identity segment.
Yeah.
So I was like, I assumed it was a small segment, right? If they don't break it out, it's probably a small segment. But Mitek does, MITK, they do break it out. And they break it out and show that this year, really as of the last quarter, it overtook their legacy mobile deposit business, which was their whole business for so long. And their fraud and identity solutions just overtook it. And it's growing rapidly, you know? And so that is a really interesting name. That's probably, you know, going to be the only other small cap I own for a while. That and OSS are the two that I own right now.
But the rest of the main ones, Amcor, ENS, you're just leaving them. You're not really.
Yeah, I own them at such good prices. You know, I own ENS in like the low 110s. I own Amcor in the 20s, low 20s. So I'm just sitting on them and just relax with the cost base. I really like both those companies still. I like the opportunity for Amcor, the forward opportunity. I don't think the valuation's gone too stretched here. I think there's an opportunity for more margin expansion, especially as Peoria comes online. Their last quarter was fantastic. Yeah. So I have no problem with how they're executing. If the stocks I own continue to execute and the value case remains intact, I stay in them. That's really how I operate. I don't sell stuff just because I'm up a lot. I sell stuff when there's a good reason to sell. So yeah, I've trimmed some Amcor contracts along the way up for sure, but the core position is still there. It's still a very, very large weighting in the portfolio. I think it's sitting at about 13% weighting. So still very large weighting in the portfolio.
Synaptics are still holding.
Yeah. As of this Friday, after I exercise, I'm still holding Synaptics. Synaptics I'm buried on. I'm sure like a lot of you are. I'm down on that one, I think like 15% from where I bought it. But that's like one of the only red names in my portfolio, so I don't mind holding it. I just still really, really like the story there. I really like the valuation. I really, really like the story. So I'm staying in it, even though I'm down. And that's kind of a rule break for me. I generally don't do that. By principle, I generally leave stocks when they leave me, if you will, when they leave my cost basis. But sometimes there's stocks I like a lot and I break the rules with that. And that's one of those names. And, I think Synaptics' opportunity in IoT is huge. I mean, their IoT business is growing 50% year over year. They have a major humanoid robotics customer that they call a leading humanoid robotics customer. We don't know who that customer is yet. And I think they have an opportunity in edge inference and on-device inference that is a huge opportunity. And so I may be a little bit early to that one. I'm not always perfectly timed with all of my thematic picks, but I tend to be right eventually. And so that's a name that I'm willing to be patient with. And so, yeah, I'm staying in it.
Thoughts on Rocket Lab before the SpaceX IPO?
I think it's a good proxy to SpaceX, but I mean, I'm not super excited about the valuation or the business. I think, a lot of times people look at like a market leader and look at the valuation they're trading at or the multiple they're trading at, and they want to extrapolate that to other companies in the industry, right? Like you want to look at, the guy who's synonymous with the industry and then say, well, my mid cap should trade at the same multiple. Like that's just not how it works. SpaceX trades at an insane multiple and an insane valuation because they own the entire industry. The entire industry. I mean, they launched 98% of all global payload to orbit. That's why SpaceX is valued the way that it is. I don't think you can extrapolate that multiple to all space and satellite stocks. That being said, they have been a good proxy to trade in anticipation of the IPO. They've been going up. They've been relatively strong versus the market. So I don't think it's a bad trade going into the IPO. All that being said. But it's not a company I'm personally interested in investing in.
Bloom Energy, any thoughts on that?
Yeah, I actually owned Bloom last year for those that were in the community in the 20s and sold it in like the low 30s. So
why?
Yeah, I owned it.
You didn't trust management, or you didn't?
No, I just didn't. I mean, I didn't think it was a stock that I wanted to see the multiple expand further than that, but the market did. And I mean, their backlog just continued to explode. And so it's become a backlog story. It's really, really hard to value those for me. So I can't get involved with it at these prices, but I did own it in Alerta last year at like 19 or 20 bucks. We were in it for a while and I really liked the setup then. And then obviously it's been a great stock since, but I can't hold and own everything forever. So that was just one that I sold too early, like many others that I've sold too early throughout the years.
Okay. People are asking, I don't think you're going to like what he has to say about this, but SoFi.
Oh yeah. I don't get the SoFi thing. I just think it's a bank that should trade like a bank trades. It's growing fast, but a lot of regional banks grow very fast. It has a little bit more of a digital angle. I don't see the financial ecosystem angle.
What's the difference between them and Robin? Why?
Yeah. So the reason I own Robinhood, I don't like the brokerage business either, to be fair. The same way that I don't like the food business, or there's like a lot of types of businesses that I don't invest in. And I just don't get the hype with SoFi because I don't see the ecosystem play. I don't think they have the momentum on the ecosystem side that Robinhood does. And when I first invested in Robinhood or really decided to exercise my calls, I had $10 and $20 calls that were expiring in January of last year that I ended up exercising. That's when I became officially a shareholder. But when I decided to exercise those, the thinking was that Robinhood had done product introduction much more effectively than any brokerage. And more importantly than that, they had done I think, very, very strong ecosystem play on the UI UX side to get people dedicated to the platform.
Yeah.
A big thing for me was like after the GME fiasco, the fact that people didn't leave.
Yeah.
That to me was a huge selling point on how effectively addictive their UI UX was. So I think they had a good blend of fast product rollouts, ecosystem feel to the application, great UI UX, and they captured, I think, a generation of investors. And that's valuable because you're going to have this great inheritance coming up. And so I think Robinhood's going to be a huge beneficiary of that. But with SoFi, I just see them as a bank, to be frank. And I don't get the hype. I don't get the hype from tech investors around them. I don't know what they're doing that's proprietary or ecosystem driven that would deserve a higher multiple. They're growing fast, but there are a lot of financial entities that are growing fast that don't enjoy tech multiples. So I think it's a bank. That's my opinion on SoFi.
Does software deserve to get re-rated to the downside?
Did it or does it continue?
Does it now?
Like further from these levels?
Well, it's two. I guess both questions. Like it fell 20%. Was that warranted? And
Yes.
then should it recover at least half of the 20% it fell?
I'm not buying the dip on software. That's how I'll answer that. I think the software apocalypse case is a pretty good case.
You don't believe Jensen around this idea of AI actually creating more work, which creates more productivity, which creates more
I think Jensen,
demand for ServiceNow?
I think people take Jensen's comments, public comments, too seriously because he has a product to sell. And his biggest customers today are effectively software companies, right? I mean, the hyperscalers have a huge dependence on software. I mean, you look at Microsoft is a software company. I mean, Microsoft is a software company. So there's a huge incentive for purveyors of GPUs to protect the software narrative. But I do think that AI will reduce the moat behind software development. And more importantly than that, I think AI will make individual workers more efficient and thereby reduce seats available to sell for software. So those two are really, really hard to avoid. And I think that that's why software deserved to sell off. And that's why I won't buy the dip. Because, look, are there going to be winners in software? Yeah, there's going to be guys that survive because of a few things. They may either have access to proprietary data sets or they may have hardware integrations with their software that are really, really high moat, right? That is a very, very niche category of software companies. Not very many that fit that, I think. Those ones will survive and probably do well. Same thing with like government contracting software companies that have this huge regulatory oversight issue that they need to get past. Those guys probably survive for a little longer. But somebody just mentioned that in the chat. Less employees means less seats, which means less revenue. And more importantly than that, pricing power goes down for software because like if you can say, if you're like a Salesforce who can go, yeah, look, you can build your own CRM, but ours is so much better. It still reduces your pricing power.
Yeah.
Because even if you say like, oh, don't vibe code that, like ours is better, please don't vibe code that. Like even if you say that, the guy who's building it for free is going to say, okay, well, mine's free though. So like, yeah, yours is better, but mine's free. That's going to be a huge problem for pricing power. So if pricing power goes down and volume goes down, the stock should go down. And that's what the market's front running with software. I don't have any pure play software exposures in my portfolio for that reason, and I don't plan on buying the dip. Do I think there's a trade to be made there once sentiment reaches peak negativity? Do I think you can trade the IGV for 20 points or whatever? Yeah, sure. I think you can do that. Do I think you look at today's software prices as generational buying opportunities? No, I don't. If you scroll through the software ecosystem today, you'll find companies that are very compelling fundamentally. You'll be like, oh my God, they're trading at X amount of free cash flow. Yeah, they're all trading it at a very, very reasonable multiples. The market's not retarded. You know, the market understands.
Can you speak to that idea that the market is smarter than what most people think? Because I thought that was an interesting thing you brought
Yeah,
up.
I mean, Stanley Druckenmiller says this all the time. Like, I don't know if anybody watched his most recent interview with Morgan Stanley, but if you haven't, you should go watch it. It's on, you can just type in Morgan Stanley Druckenmiller. You'll find it on Twitter. It's his most recent interview, but he talks about this all the time. I'm a Druckenmiller disciple, if you will. I mean, he's my GOAT. I've tried to learn as much as I can from him. I would never compare myself to him, but I'm certainly a fanboy or whatever of Druckenmiller, if you will. So I try to model a lot of my behaviors after him. But Druckenmiller says all the time, he says, being a contrarian is overrated. And he says the reason for that is because the consensus is right 80% of the time. The market goes up all the time, right? The market mostly goes up. And that's the consensus trade most of the time. And so, you know, what was the original question? There's a reason I brought this up.
Why the market is not?
Oh,
as
yeah, the
stupid
market.
as-
Yeah, the market. Yeah, so the market being right 80% of the time, the consensus being right 80% of the time, proves to you the market's a more intelligent mechanism than anyone, because the market is the conglomerate accumulated opinion of millions of participants across the world, right, who are communicating their opinion through price, right? It's the same reason technical analysis is important. Like when people are dismissive of technical analysis, I laugh because like I'm more of a fundamentally and thematically driven guy. I'm not a TA guy, but I still read charts because the price is telling you something. It is a market communicating a message to you. If there's an inability of a stock to get above a certain price, that is buyers telling you that they're selling it there for a reason. And when you look at markets overall and the signal that they send, they're smarter than any individual person because of that, because no individual person could possibly have the collective wisdom of millions of participants and their opinions being communicated through that end price that shows up on your screen. So that's really why I say that all the time. The market is smarter than anyone. And it's not always right, and it's not always right durably. The market changes its mind frequently.
Yeah.
Right? But that's also when you should pay attention. When markets are inflecting, when markets are coming off a bottom, when markets are topping, that is markets signaling to you that they are about to change their mind. Right? And that's, again, why technical analysis can be so important in order to navigate markets. So
when it comes to software, you're thinking the market is not as stupid as people think it is.
Yes.
And that there might be a legit reason why software is down.
That's exactly what I'm saying. Yeah. I'm saying everyone's looking at this software sell-off saying, well, the market is, somebody just said, remember how wrong the market was with DeepSeek? No, that's not what I'm referring to. You're referring to the market reacting to a catalyst, okay? The markets can react to catalysts. What happened after DeepSeek? The market had a V-shaped recovery, right? After it was DeepSeek, market had a V-shaped recovery, and then you had the tariff sell-off. And then what happened? V-shaped recovery, right? That wasn't the market being wrong about those events. That was an event changing the market's expectations, then the market selling to reset those expectations, and then rebounding when it realized that wasn't a problem. Right. So that doesn't mean the market's wrong because the market sold off on DeepSeek and then recovered. It was also the market that recovered. Right. So that makes no sense. I just wanted to respond to that because somebody said that there. But what was I just saying before this?
Software.
Yeah. Okay. So with software, yes. A lot of people they look at the software sell-off and they say, well, software is down 20%. It shouldn't be down because software is not going anywhere. I just disagree with that take. Like, I think a lot of software is going somewhere, and that's in the garbage can. And a lot of other software will survive. That's not to say you say every software stock is a sell, but I do think the software bear case is a real case. And I don't think Jensen is ever going to say that out of his mouth because they're his customers.
Right. By the way, guys, crude is going down and S&P is going up a little bit because Trump just said he doesn't want any more strikes on Iranian oil. Again, this market is run through these headlines. So, yeah, he doesn't want any more strikes on Iranian energy sites, but that doesn't mean there might not be more pain from the proxy strikes that Iran has been sending out, especially around Saudi Arabia and Iraq. So, I mean, a little headline after hours to get a bit of a bump, but outside of that, nothing too crazy from there. All right, last question for you. Large caps. He doesn't buy a lot of them. He has two that I think most people know already. And again, Stock Talk's Twitter putting in the chat. Those are Tesla and Amazon. I mean,
well, Robinhood, I guess, counts too because they're large cap technically. Right?
Well, yeah, that's fair. I guess I should say
mega cap. Yeah.
Real quick before that, do you like Reddit or no?
I can't really wrap my mind around the valuation.
Okay.
But yeah, I mean, I don't think it's a terrible long. I like the data angle for Reddit.
Do you like Tesla and Amazon over the next couple of months and couple of years? What would get you to sell them? How are you thinking of those two?
They're very small positions for me, like 1.5% weighting each, something like that. 1.3, I think, for Amazon, or lower than that. So they aren't really stocks I think about much. They're legacy positions. I've owned them. I've owned Tesla since 2015, Amazon since 2016. Yeah, they're not positions I think about a lot. Tesla has become less attractive to me.
Why?
Execution. I mean, it's a stock that has just been sort of, I think, fundamentally overvalued for a long time in anticipation of something happening. And now I just think there's a lot of Elon's focus on SpaceX this year and on that IPO and around XAI. And I think a little bit of his focus has been diverted away from Tesla. But also, I'm just not overtly excited about the self-driving prospects with so many competitors emerging so rapidly, and they just haven't scaled as quickly as I would have liked them to. I think one important thing about that, though, is that they still have an advantage when it comes to hardware. You know, they have vehicles that are running without LiDAR. And so that, I think, is from a practical perspective, still an important differentiation. And obviously they have the Optimus program, which if it scales, I think makes it much more interesting. So there's still a chance to turn the story around in the near term, which is why I obviously still own the stock. But I've just become less enamored with it in the last few years. And I've owned it for a long time. I've owned it for over a decade. So
You still love Elon. You just think it's not the scale up it was in 2018 anymore.
Yeah, the self-driving program needs to scale much more rapidly for me to get excited about it again. And also I need to see some actual progress on the Optimus front for me to get excited about it again. But if both those things happen, then I'll be just as excited about it again. I've just been less enamored with that name recently. But again, the weightings are so small that just not a lot of my focus goes on either of those names. Amazon I love as a company. I still think it's the best company in the world, but Jassy is just not as good of a salesman as Bezos was. He hasn't been able to sell the stock well.
Yeah.
I still think AWS as a segment is the best business in the world. Honestly, if they spun that out, I would just buy that and not own the retail. But yeah, I love both the companies, you know, in terms of their ethos and what their potential is for the next decade or so. But they're just not big weightings for me. They don't really move the portfolio at all, so I don't think about them much.
All right. Well, that's what we got, folks. Stock Talk, thank you for spending the past hour with us. Any last message in general about where you think the market is going over the short term? I know it's hard to make those predictions, but what do you think over the next couple months? How do you think this could end up playing out?
Yeah, I don't generally think about index action that way. What I will say is right now, index structure is really weak on both SPY and the Qs. And so it needs to be repaired. That's the way I think about markets, is that bulls need to step up here to the plate. And if they don't, then you get more downside. Like we're at a very critical level right now in both the major indexes. And if in the next week or so you don't start getting trending days to the upside, then we're probably headed lower. And the big goalpost that people should be looking at, forget about the moving averages, forget about chart structure. You should be looking at for a retake of all-time highs. That's what you want to see. You want to see a retake of all-time highs, because as long as markets continue to struggle with the highs, there is an opportunity for a severe breakdown. Once you take the highs out, you make new all-time highs, markets can probably breathe easy and you can get back into a trending environment. But there's a lot of uncertainty this year. I would not be somebody who in March or April of this year is throwing a lot of darts, trying to be a hero. You really don't want to do that, because this is going to probably continue to be a choppy environment where you get surprised by headlines. There's a lot of geopolitical risk, but there's also a lot of monetary policy risk. So be cognizant of the risk and don't just be like a cowboy in the markets in an environment like this. Last year, you could do that.
Because we had a catalyst, we had a bottoming event, and we had a V-shape.
Yeah,
It's
last
not
year you
the
had a
same.
nice setup. Yeah, last year you had people got scared of the market at the beginning of the year on tariffs. Then it was a not as bad as expected scenario. Trump lowered tariffs on anyone, started signing deals left and right. And then the markets recovered on that and had an insane year. And this time we don't have as easy of a back out scenario. So yeah, that's kind of the way I'm thinking about it. Just be cautious. I think stick to the names that you like. the names that you understand and have good cost-based advantages on, stick to those. The stuff you can afford to take more risk on, get rid of it and just revisit it 30 days later. There's nothing wrong with revisiting a stock 30 days later if it's just not doing what it needs to do for you or giving you a hard time or whatever. You can go back and check it out at a later time if you want to. So the market doesn't go anywhere. Stocks don't go anywhere. I mean, some of them do, but most of your stocks will still be listed, the ones that you want to buy, hopefully. And you can revisit them after an event like that. But right now you're in a choppy environment by definition. It's really hard to get traction in an environment like that. You're not going to have trends. And when you don't have trends, you sit on your hands. That's at least my point of view. So I'm sitting on my hands. I haven't done much in the markets over the last several weeks. I'm defending performance well because I've reduced options exposure dramatically, which has allowed my portfolio to sort of consolidate during this period rather than go down. But considering we're only 3 months in and I'm at 55% of the year, I'm very, very happy with that. So, I plan to do well this year. Hopefully we'll get the trend to be an ally of ours in the back half. And if not, then just continue to protect capital into the end of the year and hope for better setups next year.
I love it. Stock Talk. Thank you so much. Thank you, everybody, for being here. We'll be back tomorrow on the Market Open.
Take it
Appreciate
easy,
everybody. Bye, everyone. Have a good one.